housing, and one name she's completely...
Well, hello there. Welcome back to another, well, FOMC meeting. These are always actually really ridiculous, and here's the way this is going to work. First, for the next 30 minutes, we'll look at the market. We'll determine potentially how the market is starting to price in either fear or hedge, or start even potentially offloading some hedges, which is an expectation that we have today that could happen. And then we'll look at some prior issues that we believe will rise in this meeting. We have the following scenarios that could happen today, and we are expecting either the following: a dovish cancellation of all tightening. I think that's about a 1% chance. On the other extreme, we could hike and end the taper. So in other words, end the taper early, not like we expect in March, and hike rates early. I think this is a 1% chance as well, but obviously it is a possibility. We could end up in a situation where we have no hike now, but we do complete the taper. That is a possibility. I would give this about a 5% chance. Instead, the base case scenarios are between two choices, and it's all going to come down to not the statement that comes out. In fact, if you look on screen, like right here, you see the Federal Reserve statement will be coming out in about 29 minutes at 11 a.m., and then the Fed Q&A will be coming up at this 11:30 section here. And what we're going to look for in the Q&A is guidance in terms of, okay, so if we expect the taper to complete by March 16th, are you also going to hike rates March 16th? Presently, 90% of the market believes the answer to that is yes, and we are pricing in one rate hike. However, markets could move slightly bearish if Jerome Powell suggests it is possible that we see a half-point rate increase. Now, no matter what happens on January 26th, which is today, March 16th will continue to be a massive catalyst. As we go into this video, I want to make it crystal clear. This morning, I posted a video breaking down that I am in the market. I am 46% in the market with long trades, 0.01% short, so very much long, but I am 55% cash. So if we end up getting bad news, or the markets, for whatever reason, react miserably after this, I got cash. Otherwise, I do have bets on small cap stocks. The reason I placed bets on small cap stocks, which you can see exactly which tickers and everything in my last video, just watch my last video on the channel. I break down everything in there, broke everything down within like 2 hours of actually making the trade, so check that out. Then take a look at that video. You'll see that. And the theory for this is, this today, in my opinion, is a very hedged event. A hedged event means we know with certainty that something is going to happen at a certain date or on a certain date. We saw this same kind of stuff when we had the election. We knew when the election was going to be, just like we know when earnings are. So what oftentimes happens, not always, is volatility often goes up before the event and then down after the event. Not always. Keep that in mind. I noticed in a lot of the small cap stocks, specifically the ones I talk about, volatility was actually substantially low, which makes buying call options somewhat useful. Remember, with call options, if you're buying options ever, you want to buy options when volatility is low. It's literally the same thing as price. Buy low, sell high. Same thing goes for options. But beyond talking about options and trading, we got to focus in this video on the Federal Reserve. A hedged event is usually followed by an offloading of hedges, either substantially in the profit or as a loss. And see, the nature of a hedge is that generally people hedging or shorting don't necessarily want their hedges to pay off, and they're willing to take a loss on those to protect the other part of their portfolio that's generally long. And so most of the times you'll find institutions are more long than they're short, although sometimes you'll find very bearish institutions who are more short than they're long, right? But anyway, I always think transparency is very important. Clarity is very, very important. I do not think the market is out of the woods. You know, we're not out of the pain that we're going to experience over the next rate hike cycle. There's going to be a lot of uncertainty in 2022. I think we're going to have a lot more uncertainty in 2022 than we did in 2023. This explains why, in my opinion, my cash position is relatively large. But anyway, let's take a brief look at the market here. And then after a brief look at the market, what we'll do is we'll jump on over to some FOMC commentary previously, so we can somewhat understand a little bit more about expectations. And we've got about 24 minutes to go until the statement is released. Now, remember, the statement is just going to be a quick statement in terms of did we raise rates today? If we raise rates today, like if that statement comes out and it's like, oh my gosh, they're raising rates today, the market will potentially crash. The market will probably fall 4 to 7% instantly. I mean, it will be a crash the likes of which you've never seen before, or whatever. Anyway, I don't think it'll be good. Now, the Federal Reserve, it's important to know, does not give a crap about your stock valuations. In fact, they want valuations to come down, but they don't want to shock the market, because even though valuations could trail down, that's not that big of a deal to the Fed. What matters is shocks. When you have sudden massive declines in values, because that creates a liquidity crisis, credit tightens up, the bond market freaks out, everything freaks out. And that's what they're not trying to do. The way I picture what the Fed is trying to do, and I wouldn't be surprised if they use analogies like this, although maybe that's just what they think to themselves. Who knows what they actually said. We'll find out in like 8 years when they release the transcripts, which is different from the minutes. Minutes is like a summary, right? But anyway, I think what they're trying to do is boil us like a frog in a pot of water. And so they put us in the nice, relaxing water. It's stimulating. It's really nice. And they're trying to turn the heat up on us so we don't realize that it's, we're boiling like frogs eventually. That's my belief. I don't think they want to come in and just like, pour lava in it or something like that. And because then it's like, oh, I'm jumping out of here, that's not the intention of the Fed. Although, intentions do not necessarily have to align with reality. So, okay, let's go ahead and see what we got going on in the market today. So we're going to jump on over to a couple different platforms here. Let's go ahead and start with Webull. Okay, here we go. So what do we got here? Lobster, frog, same thing. Who cares? Whatever. You get what I mean. All right, so what do we got here? Okay, so what we have already forming is smaller caps doing quite well today. You've got AMC sitting at over 10%. A firm is getting closer to being a small cap, but it's still technically a mid cap, and so is DraftKings. But a lot of these companies that have sold off in a bloody way are really recovering very, very nicely today. And if you want to know, again, exactly the positions that I took, I mentioned exactly which tickers I bought in the video earlier. Of course, every time I buy or sell something, whether I add to a position or I close a position or whatever, no matter what I do, and it's not trading advice or financial advice, whatever I do send those alerts in the Stocks and Psychology Money group instantly. I can't get those updates out that fast on YouTube. So that's where they're all posted instantly. And then you have a whole historical record of them too. But anyway, let's take a look at what we've got here. So we've got Luminar Technology. So they are a LiDAR provider, and we've been doing a lot of research on Luminar. And one of the things that really makes me excited is their partnerships with NVIDIA, but more importantly, and they partner with multiple different companies, not only to be one of their exclusive LiDAR providers, which there are many different forms of LiDAR, but they're also working with trucking companies. I mean, there's so much good to say about Luminar, and it really merits its own video. But what we're seeing here is Luminar, GameStop, Shift Technologies, Workhorse, DraftKings, Hut 8, Affirm, Bakkt, Lordstown Motors, Upstart. Pretty much anything that has been affected by momentum is coming back to life right before the Fed meeting. Now, this is actually a little bit different from my original expectations. I did want to buy this morning, and so I bought at market open. That's when I executed my trades. It was right at market open. Within it took about 45 minutes. So within 45 minutes of market open, we got the various different trades in. And this rationale, it was that we probably would have had lower prices before the Fed meeting than after the Fed meeting if we end up getting a base case scenario response, which is, again, March 16th rate hike, taper done in March, not ending the stimulus yet, not ending the cheap money yet, because it might come as a surprise to you, but while we are talking about raising rates, we actually are still printing money. Now, I get this in the comments sometimes. People are like, Kevin, we don't actually print money anymore. Yes, we do. We digitally print money. We basically go on a spreadsheet and we're like, oh, we have $1 trillion on the asset side and $1 trillion on the liability side. Let's create an extra $1 trillion. Okay, open up spreadsheet, and then JPal goes in there and select one, make it two. Select one, make it two. Boom, just created $1 trillion. Literally, that is digital money printing. It's honestly very weird. It is a phenomenon that makes a lot of people nervous about how fragile our insane monetary system potentially is, and I think that has given way to a lot of folks being very, very excited about investing in cryptocurrencies, which makes sense because it's like, what, we can't just digitally print crypto. Now maybe you can with some, like if you bought Squid Game token, which I made a video highly encouraging people not to buy it because I thought it was a scam. Ended up being a rug pull. But anyway, so the phenomenon of the Fed is crazy, and it's led to a lot of skepticism. But still, everybody pays attention to the Fed, and the statement comes out in the next 18 minutes here. Everybody's watching the Fed. And that's because the Fed moves the market. Whether you like it or not, whether you think it's rigged or what, they move the market. And again, based on these base case scenarios here, we could see these stocks that are doing well right now, which I wouldn't be surprised if we get a little bit of a sell down right before the meeting, but we might not. If we do end up getting any kind of drawdown right before the meeting, I do think that potentially, and this is, again, not financial advice, there could be potentially a little bit of a buying opportunity. Oh no. Oh, I disappeared there for a second. We can't have that happen. Uh-oh. Am I back? Hold on. Let me restart. Here we go. Am I back? I hope I'm back. Dude, what is going on with this dumb computer? Oh! I hate this. There we go. I'm back. Okay. All right. Computer is so stupid. That wasn't even an internet thing. It was, so I use my iPad as a second screen, and the Wi-Fi of the iPad disconnected from the computer, and then the computer started freezing. Can somebody please short Apple for me and make money? Not financial advice to short Apple. It's Warren Buffett's biggest position. But man, Apple, you're killing me. You're making me all stuck here, step bro. Anyway. Okay, so look, if we get bad news from the Fed, the market's going to go down. We know that. However, if we get news that is expected or good news, the market could potentially rally if we have shorts unload. Now, I want to be crystal clear. We're still going to have a lot of poopy doopy to go through over the next, honestly, year as we go through this rate hike cycle. But we do not want to, potentially miss a bottom either, right? So this is where it's like, okay, do we nibble in on some that we think could have outsized movements? And this is really where you have to make your own decision in terms of what you want to do. The good news over the last 2 trading days, that's Monday and Tuesday, is that we actually had a higher low on Tuesday, and we had a very similar pattern reversal within the first 3 hours of trading. And that was potentially a bullish indicator that the market had hit low. And when folks started recognizing that we hit a higher low on Tuesday, the futures market actually started increasing. And it's interesting because that's exactly when the futures market started going up, was once we started getting news coverage that, wait a minute, we potentially are hitting levels that are indicative of a bottom, right? Again, no guarantees, but very, very interesting. Okay, so let's see here. All right, let's go ahead and jump on over here and see what we got in the crypto market. Okay, this computer sucks. This is I'm just going to complain really quickly and rant. This is a Mac Pro, and it sucks. It is not the fault at all of our beautiful streaming provider, who I owe a lot to. There we go. Am I good? Nah, now I look frozen. Come on, man. I hate this computer so much. Okay. I don't know if you can still hear me, but we'll get this thing going here. I hate it. I hate that computer. I just hate it. I hate it. Somebody buy me a Dell, please. Take this freaking computer, throw it out the damn window. All right. Anyway, okay. So, look, taking a look at crypto, which I like looking at crypto because lately crypto has been a little bit of a tell for us as a potential guide of what markets could do. We are starting, and it's weird. Like crypto has been leading the stock market moves lately. It led the stock market futures up. We saw futures move up on Tuesday, Monday, and Tuesday when Bitcoin started moving up. That's when we started seeing the market move up, sometimes 5 to 10 minutes later. So right now, we are getting a little bit of a drawdown in BTC. We're back to about 37.7 right now. Now, that could potentially be a buying opportunity because we're certainly lower than where we were last week, unless, of course, you think we're going to get bad news from the Federal Reserve, which is entirely possible. I want to make it clear that some folks are expecting the Federal Reserve to hike today. Some folks are expecting a double rate hike, or potentially even estimates that we need to raise rates to over 1% or something extremely bearish. I have made it clear for at least the last few weeks that I do not believe we are going to get a surprise rate hike today. I do not believe we are going to get a surprise end to the taper today. If we get either of those, again, lower chances. It's going to be a little bit more of an oopsie doopsie. So we'll see what happens. Keep that in mind as you're betting on the market, and stay out of margin. And if you have margin, limit your margin, but and don't get margin on crypto. These are just some of my thoughts. All right, so let's take a look at how well. I mean, let me just say, as this computer comes back to life, stupid computer here, how markets are moving. We've got about 10 minutes to go to the Federal Reserve announcement, which is going to be very exciting. All right, here we go. So it does look like right now on the 1 minute chart, we're kind of consolidating on the SPY. So we're not running and we're not rotating to the downside. We are consolidating. Typical consolidation pattern. Very, very, very typical in trading. And what you end up finding is markets or stocks or indices can tend to break out of a consolidation pattern, either to the upside or to the downside. I'll show you this pattern in just 1 second, but we are getting that on the SPY. And I'm going to quickly pull up QQQ, and then we'll come back to that pattern. There we go. Okay, QQQ is showing literally the same exact consolidation. All right, here we go. I think we are back up and running here. And then I'll be able to share this. So in the meantime, while that comes, BTC again, 37.7 right now. We are now 10 minutes away from good old JPOW. Okay, there we go. All right, switching over devices really quick. There we go. Nope, that didn't work. What is going on today? This is like the worst. This is the worst. This is just the worst. I cannot stand this today. Whatever. I will get to the bottom of this. Okay, so anyway, here I'll just show you the consolidation quick. No, not like that. Whatever. Here, old school way. Okay, see right here. This is what's happening. You're getting compression between the highs and lows. That's a consolidation pattern. It's happening on the QQQ and it's happening on the what's it called? The SPY forensics on my computer. Yeah, no kidding. I just did a full restore on the stupid thing too. That's just so toxic. Anyway, okay, so we are now 8 minutes away from the Fed decision, which should be fun. All right. Okay, let's go see. I want to see how some other stocks are moving before. So Luminar is relatively stable right now going into this Fed meeting. GameStop's up 15%, folks. AMC is only up about 9.2, a little bit more bouncy than what we're seeing with GameStop. We are, let's see here, backed holdings. Backed holdings. So I want to talk about backed holdings. The ticker symbol on this one is BKKT. It's backed holdings. This is a fintech payment processor for crypto, or at least they're like an intermediary for payment processing for crypto. I did a full video on them. So if you type in Meet Kevin BAKKT Holdings, you should be able to find it. I was not very happy about the stock when it was going euphoric. The company had this insane momentum movement, and I made a video about it saying this is ridiculous, like an overvalued company. It ran from about $9.30 to $8.80, which is where it had stabilized, all the way up to $50.80. And that momentum bled out, just like your typical kind of momentum curve. And right now, the stock is sitting at $4.30, which is ridiculously low. A lot of things have fallen to just absolutely insane lows. And again, in my opinion, there are buying opportunities in those. Okay, so that's backed. We got Microvision up 9.25%. I think Microvision is moving right before the Fed news. Jeez, man, this computer's slow. I think Microvision is moving before this news. Up 9.5%, mostly because Luminar is moving up so well. Luminar, obviously a LiDAR provider, a lot of enthusiasm around Microvision. I really love the forward-facing aspect of the Microvision LiDAR, but I think Microvision is either like, and I don't know this, maybe somebody can correct me if they have the best information, but at least based on the latest research we were doing on Microvision, it didn't really look like Microvision was either prioritizing the forward-facing LiDAR for automotive, or potentially had even just given up on the project. So I'm not sure about that. I don't want to spread fake news, but that's something to fact check. So I think that's why lately we've seen a little bit of this preference towards Luminar over Microvision. All right, we got GNOC DraftKings, folks. That's another one that has just hit low after low after low, and it's quite devastating. What you're really looking for is a floor for this sort of company, and we just have not found a floor for these companies, which is kind of insane to think about. They continue to break to new lows. HUD 8 Mining and Backed, I do want to say both those will substantially follow whatever BTC does. So if BTC ends up moving green, then those might end up moving green. If you end up getting red on crypto, those tend to follow them. That includes Backed, even though they're a crypto payment processor, right? Even though they're just a listed stock and they're not a crypto miner, they're vastly affected. It's kind of like Coinbase, which is also at incredibly new lows. It's a little wild, but anyway. So remember, the big thing for Coinbase that you have to remember is they need to transition their customers from a level of profit off of transactions to secondary services, which would be like
credit cards or margin lending or whatever, that's where Coinbase is going to shine when they can make that transition happen. Until that transition happens, you're going to see earnings probably go down on transaction fees as we get out of this crazy momentum phase we've been in. Oh my gosh, am I up again? Hey, look, we got two Kevins in here. What up, y'all?
All right. Oh my gosh. I'm sorry. That was like the last 10 minutes was, and I tried not to show it, but I was boiling on the inside more than this cup of coffee, because this cup of coffee, which I should have been sipping in the last 30 minutes, is now getting cold because I've been ranting. By the way, StreamYard sent me this cup, and I know it sounds weird, but whatever happened with the live stream is not StreamYard's fault. I do use StreamYard. If you want to learn more about them, you can go to metkevin.com/StreamYard. This is 100% a Mac issue. I actually solved it by unplugging some HDMI cables from it, and it's my Mac. One of these days, I'm going to throw it out of the window, and I'm going to make a video, and I'm going to post it. It's probably going to be a short, and you're just going to see that $5,000 Mac Pro display go, because obviously the display has a lot to do with it. Anyway, okay, let's get ready here. Okay, so all right, we got 3 minutes to the statement here. This is a big moment. 3 minutes to the statement, and the way this statement comes out is critical, because what you need to know is that the statement is usually given to news agencies. So news agencies probably have the statement already. Usually the statement is what happens is the news agencies get one reporter that gets put into a room at the Fed, or that's how it used to be before COVID. And they're not allowed to publish or post anything until right at 11 a.m. This is known as an embargoed news release. I don't know if they still do this with COVID, but they always used to do embargoed news releases. This does mean that even though I'm going to be sitting here doing my best to get this information the very second it comes out, I am, as a hedge to myself, going to play CNBC at the same time that we hit 11. So if I get it first, you'll hear it from me. There's a 9 out of 10 chance in this case they's going to beat my butt. But that's okay. That's all right. I do want to also mention that FTX US is also sponsoring this video. I use them for tracking my Bitcoin prices and Ethereum prices. I love the TradingView tools that you can incorporate with them. Absolutely incredible for trading. Check them out by going to metkevin.com/FTX US. And if you sign up with an affiliate link, you get 10% off on your trading fees, which are already relatively low. They're 85% lower than competitors. Okay. Here we go, folks. We are now 60 seconds away. Again, what you are looking for, I want to be crystal clear about what you're looking for. Rates stay the same. And then you want to look at the taper. We're going to see a reduction in bond purchases. You are going to see a reduction in bond purchases probably to something like $30 or $40 billion left for the next month or two. And that's okay. That's part of the taper process. You do not want to see them go to zero. If they go and they say we have completed the taper, that's potentially a bad news catalyst. So we'll see. Oh, I'm nervous. Got dollars on the line here, folks. Dollar hollers. All right, let's listen in. We got 10 seconds to go. The Fed is usually timely with their releases, especially if this is an embargoed release. You ready, folks? Here we go.
About a March rate hike, 4 rate hikes this year, end of QE by March, and potentially start of QT as well, but all in line thus far with market expectations.
Mona, we're going to interrupt right now and go to Steve Leisman with the Fed decision.
Tyler, thank you very much. The Federal Reserve leaves interest rates unchanged, but it says in its statement, the committee expects it will, quote, soon be appropriate to raise the target range for the federal funds rate.
Good.
The statement said inflation is well above 2%. Now, the Fed continues to taper asset purchases. One more round it will make in February. And the statement says it will end the asset purchases in early March.
Let's freaking go.
Saying the Fed will use its full range of tools to support the economy. notes the sharp rise in COVID cases continues to affect the economy, but says overall economic activity and employment have continued to strengthen. Job gains, it says, have been solid. Supply and demand imbalances, mostly related from the pandemic, are contributing to inflation. The path of the economy, keeping a line from prior statements, continues to depend on the path of the virus. Risks to the economic outlook, the statement says, remain. The committee says it's prepared to adjust its monetary policy stance as appropriate. Now, it makes no mention of the balance sheet, but it does have its new long-run statement out, which I don't see a whole lot of changes, but I want to note one line from the statement where it says the primary means of adjusting policy is through the Fed funds rate. That has been the policy of the Federal Reserve, and it remains the policy of the Federal Reserve. No mention, Kelly, of any balance sheet adjustment in this statement. Suggests that maybe the Fed is not prepared to announce or come to a decision about what to do with the balance sheet. But that one statement from the long-run policy says that the Fed funds rate will be the primary means that the Fed will address policy and the economy.
All right, Steve, thank you.
Okay, yes, this is absolutely true. Now, in the last report that we had from the Federal Reserve, and keep in mind, look at what's happening right now in the markets here, okay? We got BTC moving up on this news. This is expected. The SPY is moving up on this news. Tesla's moving up on this news. What they just said about the Fed funds rate being the preferred method of controlling or responding to the economy has to do with the yield curve. Now, the yield curve is something really important to understand. Basically, if the yield curve goes down, I'm not going to go into detail as to exactly what it is right now, but if the yield curve goes down, then then we might risk a recession, possibly even a deflationary style recession, if the yield curve keeps flattening and potentially even inverting. That is a big risk or fear. Now, that does not necessarily need to be what happens. And over the last month, the yield curve, instead of flattening, or in other words, falling, has actually stabilized. The reason that is critical, that the yield curve stabilizes, is because it allows the Fed to say, okay, let's go ahead and stick with what our expectations are. Rates over a super fast taper. And the reason this matters, because even though we don't necessarily want rates to go up, it is along expectations. You don't want the Fed to say something like, oh my gosh, the yield curve is freaking out. We need to really quickly change strategies, because you can't pick your poison. The Fed does. And the Fed changing strategies is bad. Nobody wants the Fed to change strategies. So them maintaining this strategy is very, very good. BTC now at 38.5. This is good. I do have the statement down. Jerome Powell will be speaking in 27 minutes. This is part 2, okay? That's when things get critical, because that's when Jerome Powell is going to read some prepared remarks, and then he's going to start talking to us about none other than our questions, brought to you by all your favorite reporters from the Wall Street Journal, CNBC, New York Times, and all that good stuff. They don't take any questions from the public. But anyway, this is where they're going to get drilled about, hey, what kind of timeline do we have for rates possibly going up? Okay, let's take a look at what we've got here in some moves here. So we got Palantir up about 4%. ARK is moving up here. You've got Bakkt. Bakkt shot up nicely on this. It's about 4.46. Luminar went up, looks like about another 1%, held on to some of its gains so far in the day. Hut 8 Mining moving up on this news. So we're seeing those smaller and some of the smaller, even the mid caps kind of move on this. Let's take a look at how Tesla is moving on this. We expect every kind of tech to be moving up on this news. Tesla absolutely moving up on this news. Now, I don't love the idea of trading into Tesla the day of earnings, because like 6 out of 8 times, earnings tend to lead the stock to go down afterwards. Last time was an exception, I feel like. We will see. But anyway, a lot of movement right now in stocks. I want to see if anything's actually rotating more to the downside. And remember, we have the Fed Q&A with Jay Powell in 20, or I'll just say at 11:30 a.m. PT. Again, that's in 24 minutes. But this is literally what we were expecting. This is the base case scenario. This is not any kind of a freak out result. This is not a rug pull. This is what we were expecting, which is very good. You've got the volatility index falling substantially. It's so funny because yesterday I was running math and I'm like, oh man, I should short the ProShares VIX short, which is ticker symbol UVXY. I didn't end up making that trade. I wish I did, because if I had shorted it and then it fell 12%, that would be good. That's okay. I made other trades, but that was one of the ones I'm looking at. It's just a strategy for you to have in your back pocket when volatility goes down. Lucid is actually recovering. Look at that recovery on Lucid. It was down a couple percent right here. Even Snap is recovering right now. The stock market is loving this dose of certainty. This is the best case that we could have gotten, and we got it. Robinhood's really lagging behind. You've got a little bit of a recovery here on Etsy, Google, Trade Desk. Folks, these companies, great long-term holds, long-run investors, in my opinion, should be very, very, very happy and comfortable. Maybe not necessarily happy because recently things have been going down, but should be very comfortable, not financial advice, with companies like Google, Etsy, Trade Desk, Enphase, Lemonade. Lemonade is another one that's moving up on this news here. Lemonade could potentially set up for a short squeeze. No guarantees, obviously, but Lemonade is very highly shorted, along with Shift Technologies. These are some of the companies that became sort of the butt of the joke for hedge funds. So Shift Technology up 18% today. No guarantees that obviously these will maintain any of these sort of prices here. AMC now at about 11%. Okay. So obviously market reacting positively because we did not get the worst case scenario here. Thank God we got what we expected. We talked about that a lot, obviously, not just in this video, but even beforehand. This is literally what we were expecting. So thank you, JPow. Now, let's look at the actual statement. I'm really just going to look at the statement to see if I can pick out any particular keywords myself. So what I'm going to look at here is really changes. So indicators of economic activity and employment have continued to strengthen. Okay, so when they say indicators of economic activity and employment go up, that's actually something that would reiterate hike. That is a way of them saying, like, okay, it's appropriate to hike, right? The sectors most adversely affected by the pandemic have improved. Another way of saying hike, right? But are still affected by the recent rise in COVID cases. Job gains have been solid in recent months, and the unemployment rate has declined substantially. We've already had certain members of the Federal Reserve Board say we have reached maximum employment. We have achieved our expectation for employment. That means we can raise rates and start dealing with inflation, which inflation measures continue to come in higher and higher and higher. We do expect, and the best case scenario for this market in 2022, absolute best case scenario, I'm 60% hoping this happens. Best freaking case scenario is we end up getting disinflation at some point this year. I have no freaking idea when that's going to happen, but that is, if you want to dream for something for 2022, dream for disinflation. That means is inflation starts rotating down. We just had a survey that came out of the New York Fed. And when I say survey, it's more like it's their version of an economic study. It's not like some guy just standing in the street. Like they try to do well. Some people don't believe them, but whatever. The Fed's economic survey on consumer spending is indicating that individuals are spending more money on non-essentials and less money on essentials. That is a way of the Federal Reserve saying, it looks like people are more and more affected by inflation, which is a problem, right? We'll get right back to the statement. I do want to take a quick peek here at BTC. Nice movement again here in BTC. We are almost at 39,000. This is, in my opinion, bullish. Want to be transparent. I did buy 4 coins this morning leading up to this meeting, and I also invested in a lot of small caps this morning. I did post a video this morning talking about some of those ticker symbols. Of course, if you want every single move that I make, whether it makes money or not, check out the programs linked down below on Building Your Wealth. There's a coupon code expiring in 2 days when I turn 30. In full transparency, last year I had trading gains. So not like paper, profit and loss or whatever. Trading gains is somewhere around $3 to $4 million. So I'm happy about that, but I'm not happy I pay taxes on that because I looked at it like, oh crap, I didn't pay taxes on it. But anyway, let's go back to this Fed statement here. Okay, a little bit of a move here on BTC. I do expect some volatility as we get to the Q&A section with JPow. The Q&A section with JPow, in my opinion, is actually something that makes me a little nervous because, you know, all he has to say, remember, we're down to 2 cases right now. Here, let me, where did I put it? It's right here. No, it's this one. One of these. Yeah, here it is. Okay, so this is my expectation. So I have a whiteboard, and at night I kind of throw ideas on this. That's what my evenings look like, is talking to a whiteboard and other people and strategizing and stuff. So again, we believed that hiking now and a taper now would be a shock, and it would be 1% likely. It did not happen. We believe that tapering now with no hike would be 5% likely. That would be a shock. It did not happen, which is good. Being dovish and canceling all of the talk about taper or whatever, or rate hikes, very unlikely to happen. I gave it a 1% chance of happening. Did not happen. Now, we are in between these two cases right here. The two cases right here are either hiking on March 16th with a 0.25% basis point increase, or maybe giving us a schedule or a double. Schedule or double would mean like we know exactly when the rate hikes are coming, probably not. And a 0.5% increase would be a double on the rate. Not something that we're looking forward to. A little bit of a decline right now on the BTC chart. Little bit of a pullback in some stocks that were rallying. This is why I was saying, like, not you don't want to like run in and follow these sorts of jumps. Just for example, Tesla rotating right back down right now to where it is. Why, folks? Why would these things be rotating back down? Because we've got the Fed Q&A coming up, and that's going to be big in 18 minutes. That's going to be part 2 of uncertainty. We checked one thing off the box, but we still got part 2 of uncertainty. What did I say right before the statement came out? You might end up having a buying opportunity between statement release and when Jerome Powell speaks. That's this. Now, again, no guarantees. We are still in for a crappy year, but I do not think that chasing this is necessary right now, because there's still going to be some. It's too early to offload hedges. It's really too early to party because of what Jay Powell might say, and he's going to be talking for about probably 30 minutes with Q&A. Okay, let's go back to the statement here. Supply and demand imbalances related to the pandemic and reopening have continued to contribute to elevated levels of inflation. This is a problem. This reiterates the need to taper and to deal with inflation. Keep in mind that we just had 3 earnings that came out yesterday, and all of them were somewhat concerning regarding inflation. General Electric complained of persistent inflation and struggles completing orders because of supply chain crises. Raytheon took a $150 million hit because of inflation, and they believe it's delaying their ability to deliver things like engines for planes or jets. Then you had 3M, the mask manufacturer, who refused to give guidance and expects to give guidance in 2020 or in February 2022 because they're so confused about the supply chain issues. So keep that in mind. Okay, let's keep looking at the letter over here. Path of the economy. Well, let me make sure I didn't miss anything. Overall financial conditions remain accommodative, in part reflecting policy measures to support the economy and flow of credit. In other words, they're still providing money, right? They're still printing. It's just weird, but they are still printing. Tesla almost exactly back to where it started before this statement came out. So whatever gains you had in like the last 10 minutes are right back to kind of where they were. They're not net lower yet, though, for most things here, though this Q&A is going to be a critical moment. We'll see. All right, the path of the economy continues to depend on the course of the virus. Progress on vaccinations and an easing of supply chain constraints are expected to support continued gains in the economy. Okay, this is good. Progress on vaccinations and easing of supply chain constraints. So far, a lot of companies aren't seeing that kind of easing of supply chain constraints, so keep an eye on it. All right. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. In support of these goals, the committee decided to keep the target range for the Fed funds rate at 0 to 0.25%. With inflation well above 2%, the committee expects it will soon be appropriate to raise the target rate for the Fed funds rate. So this line right here is basically giving us crystal clear guide that we are expecting that move on rates March 16th. So keep an eye on that. Very, very important. So let's see here. Then we've got
Beginning in February, the committee will increase its holdings of Treasury securities by at least 20 billion per month, and mortgage-backed securities by at least 10 billion. That's funny. That's literally what I said before the statement came out, that they're probably going to go to 30 bill, and that would be expected. So that's good. This is what we're thinking. Fed's continued purchases will help smooth the transition. In assessing the appropriate stance of monetary policy, we'll continue to monitor. They can adjust at any point if they need to. And there you go. Okay, so now J-Pow comes out in about 14 minutes to talk. A little bit of a U-turn down right now because it's the Q&A section that's usually the one that creates a little bit of nervousness in the market. So because we got the good news. The good news is over. Now it's like, okay, what now? What's J-Pow got to say? And as long as nothing really gets said that would make the market nervous, hopefully the market continues to go green. However, just want to be crystal clear. I'm 45% in the market and 50%, 55% not, because we are going to have a volatile 2022. Take a look. Speaking of volatility, we're going to go over here to FTX. Remember, you can go to metkevin.com /FTXUS to trade with FTX. And if you use that referral link, you get 10% off of your trading fees. Here, we are seeing this volatility literally play out. We were barcoding essentially right here, ran after the news and almost instantly traded right back down. This is very likely because when you have catalyst events like this, there's a lot of trader activity that comes into all sorts of securities. And it's worth noting that until the event is fully over and then the market really digests them, the market does not have to move to the upside. And quite frankly, the market digesting news hasn't lasted green very long. We've gotten a lot of fake out rallies, so it is something to be cautious of. Okay, let's go ahead and see here. Let's go look at some individual stocks here. So look at that, going right back to where we were before on Shift Technologies, right? GameStop barely even moved here, which is quite interesting. Let's look at Tesla here. Tesla was ripping right after the announcement. And look, it's essentially gone right back to the support of where we were. It's almost like the stock market was kind of like, yay, this is good news. Oh, crap, we still got to wait for Powell to talk. And then just like rotates right back. It makes sense. Completely makes sense. That's exactly why I said there could be a buying opportunity between the statement release and J-Pow. But there's a lot of risk. I mean, we don't know what tone J-Pow is going to strike. If J-Pow comes out and he sounds like a, like a D-bag, it'll be bad. Not that I think he will. I think, look, I'm gonna make a guess here. I'm gonna pretend that I am Jerome Powell, and I am going to just pretend to answer some questions. So, for example, I'm going to get asked, "Hey, would you consider basically a 50 basis point rate hike?" And I'd probably answer with something as J-Pow political of like, well, we don't want to take any options off the table or items out of the tool belt. But at this point, we don't believe something like that would be necessary. And we'd much prefer to essentially use quarter point rate hikes and then just adjust the number of them. I'm hoping he says something like that. But that's probably, I'm like 70-30 on that one. So I'm not sure if he's going to give us a clear answer on that. He could also blow us off because we know he's going to get the question. He could end up blowing us off and just saying something like, that'll remain an option, but we don't have an answer at this time. That's also possible, which would be the most unfortunate, because guess what happens then? If you get an unclear answer from J-Pow, then you create uncertainty again. And this is that uncertainty period that I'm talking about, where it's possible, depending on what J-Pow says, the market could kind of kick the can of pain down the road from Jan 26th to March 16th. Best case scenario here, we get clear information from J-Pow. Now, the reason I believe we're more likely to get clear information from J-Pow right now is because he has made it
critically clear that he wants to give the appropriate expectations to markets because they want to raise rates without shocking the market. Honestly, Jay Powell will probably consider his career a substantial success, in my opinion, if he is able to raise rates potentially all the way up to 2%, 2.5% even, and not crash the market like he did in 2018. In case you're not familiar, in 2018, the Federal Reserve, was sort of at the end of its rate hike cycle, and they crashed the market. The Nasdaq and S&P were down 20% by December of 2020, within the span of about 6 weeks. Very, very bloody end to 2018. And on December 19th, Jay Powell comes out and says, hey, everybody's been thinking we're going to raise rates 3 times next year. We're just going to raise rates 2 times. The market loved this, but it took time for the market to recover. The market didn't actually bottom until 2 days later on the 21st, and then we started the rally. So I think that is an important lesson for what we're looking at right now, is not to expect the market to necessarily balloon instantaneously, but potentially to take about 6 weeks to really price in whatever hopium Jay Powell gives us. Remember, he does not care about your valuation. The valuation of your stocks is not a priority to Jay Powell at all. Now, sometimes when I say that, people are like, what do you mean it's not a priority? Jay Powell thinks, and the Fed believes, that excessive valuations in the stock market lead to excessive debt and risk-taking, which are downside catalysts to the market by potentially forming a bubble and then crashing the economy, right? We don't want that. And so instead, it's much easier to bleed stocks of valuations like what we've seen over the past 3 or 4 weeks, or potentially even 8 weeks at this point, and then just try to get to a normalized market where we recover normally. So this right here is 2018. Take a look at this. So this is 2018 here, and you can see the sharp selling off that really began around December 3rd, which is kind of funny because that's when we started having a sell-off in 2021, just a few weeks ago, was December 3rd. That's when I went on vacation to Cabo, and I'm like, oh my gosh, this is like the worst time to go on vacation, but like I couldn't have timed that one. But anyway, the market ended up falling here all the way to the bottom was about here. Oh, okay, so maybe it was actually like the 24th, right here around the 21st, 24th, right around here. I am on the average candlesticks, so that could kind of mess it up there a little bit. Oh, there we go. Okay, 24th. I think I said a couple days later. So it actually took about 5 days for the market to move here. But then look at what you had thereafter. It took about from the end of December to probably about April to actually get back to the levels that we previously had. This right here should be should provide comfort to the people who are buying and hodling, and I think traders should be aware of this as well. Okay, good. So clearly we have bounced off of the support lines that we've had here at 430 and 426 for the SPY. I was really blown away that we had this kind of bounce, but hey, TA works. Do take a look at this, though. This is the S&P 500, which has rotated down slightly after the announcement from Jay Powell. We have DraftKings, same kind of pattern here. GameStop, GameStop didn't really react. Backed holdings, same kind of movement here, but still obviously up on the day. It was just a little bit tentative right now. AMC actually rotating down after the meeting from about a 10% gain to about 7%. So heads up, not all is straight up right now. Let's look like NVIDIA is moving nicely. Also a little bit down from after announcement here compared to before. Same thing with Tesla. Very, very nervous, sort of tentative behavior here. We've got, what do we got? 5 minutes to go on Jay Powell. So fingers crossed. All right, folks. Let's see. We have, okay, we've gone through the statement. We've gone through, let's take a brief look maybe to see what crypto's doing right here. Let's see BTC. Okay, so BTC, I don't know how how much it's going to lead today, but BTC tends to indicate a potential movement coming to the SPY or QQQ. I've now gone from the 5-minute chart to the 1-minute chart, and this is again very trading view here. You can. I'm not going to throw in all the indicators right now. Mostly, I just want to watch the price here. We are seeing a nice movement up here just in the last 2 minutes. Let's go ahead and take a look if that's being reiterated by the SPY. SPY, yes, it is. SPY also, again, about 1 minute behind right now. So the SPY is finally catching up again to responding like BTC. But we'll keep an eye here. Folks, we have 4 minutes until JPOW comes up. JPOW tends to be on time. I appreciate that. Yeah, and let's think of some other scenarios here quickly. So JPOW, he could say. So we talked about we gave a scenario in terms of what he might say regarding the 0.5 point increase in March. I think that's the biggest guidance. I think what I really want to hear from JPOW is any positive news on supply chains, and I believe that would get rewarded by the market if we had positive news on supply chains. Unfortunately, I've been a little bit bearish on the supply chain news because the supply chain news has not been great. The issue has been exacerbated by Omicron. However, if you jump on over to COVID cases and you look at like New York, for example, we've been seeing a plummet. COVID cases, New York. Let me just corroborate that. Oh my gosh, folks, you're going to love this chart because the more we see this kind of price action, the more, I'm sorry, not price action. You know, my head is in the sticks all day long when I'm calling COVID cases charts price action. But anyway, look at this freaking chart right here. This is exactly what we saw in South Africa. It's exactly what we saw in the UK, and it is absolutely what we want to see. Now, originally, when Omicron started spreading in the United States, there was actually a lot of fear that the United States would actually react differently to Omicron because less of the American population has been exposed to COVID than the South African population. So that means the South African population had more natural immunity to COVID than the American population. The median age is also about 10 years younger in South Africa. So there was a temporary concern that was being priced into the market that, sure, maybe cases are going down quickly in South Africa, but that does not necessarily have to happen in the United States, especially since the US is so diverse that we could end up seeing these surges in different areas. So far, though, first American test here in New York City, that's a big check mark. That is very, very good. I like seeing that. If I go to the entire United States, we do still actually we've hit a little bit of an inflection point here. That's really good. Let me go to all time here. Yeah, look at that. We're getting that trend down right here. Very, very, very good. Okay, we are now about 1 minute away from JPOW. Someone here says they are a COVID bear and they're buying puts. You know, the best time to buy puts is when the market is up. So if you're looking to hedge yourself to the downside, this is something I talked about. Look, we talked about so many different types of hedges over the last few weeks in the course member live streams. Talked about hedging your cash, which is actually really important. Talked about hedging with options. Talked about hedging with sold options as opposed to bought options. Talked about hedging using cash, like hedging stocks using cash, right? And vice versa. So a lot of things, but sometimes these get too granular, in my opinion, for broader YouTube videos. But anyway, this is the S&P 500 right here. Getting a little bit of optimism again right here. It's going to be interesting. We have JPOW coming out in 30 seconds. A little nervous, but this is very important. Now, remember, he's going to read us a boring prepared statement. After he reads us this boring prepared statement, then we're going to hop on into Q&A, and I believe Q&A is going to be the critical point. We are on standby here for JPOW. It's about 5 seconds to go for JPOW to start. I've got a few different sources up here, so we'll see which starts first. I'm actually a little surprised. The Federal Reserve is usually streaming by now. They usually pre-stream and they just show the podium. Yeah, here we go. Okay, here we go.
To achieving the monetary policy goals that Congress has given us, maximum employment and price stability.
Yes.
Today, In support of these goals, the Federal Open Market Committee kept its policy interest rate near zero and stated its expectation that an increase in this rate would soon be appropriate. The committee also agreed to continue reducing its net asset purchases on the schedule we announced in December, bringing them to an end in early March. As I will explain, against a backdrop of elevated inflation and a strong labor market, our policy has been adapting to the evolving economic environment, and it will continue to do so. Economic activity expanded at a robust pace last year, reflecting progress on vaccinations and the reopening of the economy. Fiscal and monetary policy support and the healthy financial positions of households and businesses. Indeed, the economy has shown great strength and resilience in the face of the ongoing pandemic.
Good.
The recent sharp rise in COVID cases associated with the Omicron variant will surely weigh on economic growth this quarter. High-frequency indicators point to reduced spending in COVID-sensitive sectors, such as travel and restaurants. And activity more broadly may also be affected as many workers are unable to report for work because of illness, quarantines, or caregiving needs. Fortunately, health experts are finding that the Omicron variant has not been as virulent as previous strains of the virus, and they expect that cases will drop off rapidly.
Good.
If the wave passes quickly, the economic effects should as well, and we would see a return to strong growth. That said, the implications for the economy remain uncertain, and we have not lost sight of the fact that for many afflicted individuals and families, and for the healthcare workers on the front lines, the virus continues to cause great hardship. The labor market has made remarkable progress, and by many measures is very strong. Job gains have been solid in recent months, averaging 365,000 per month over the past 3 months. Over the past year, payroll employment has risen by 6.4 million jobs. The unemployment rate has declined sharply, falling 2 percentage points over the past 6 months to reach 3.9% in December. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand remains historically strong. With constraints on labor supply, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. While labor force participation has edged up, it remains subdued, in part reflecting the aging of the population and retirements. In addition, some who would otherwise be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. The current wave of the virus may well prolong these effects. Over time, there are good reasons to expect some further improvements in participation and employment. Inflation remains well above our longer-run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services.
Not good.
Wages have also risen briskly, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline over the course of the year.
Okay.
We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. In addition, we believe that the best thing we can do to support continued labor market gains is to promote a long expansion, and that will require price stability. We're committed to our price stability goal. We will use our tools both to support the economy and a strong labor market, and to prevent higher inflation from becoming entrenched. And we'll be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. As I noted, the committee left the target range for the federal funds rate unchanged and reaffirmed our plan announced in December to end asset purchases in early March. In light of the remarkable progress we've seen in the labor market and inflation that is well above our 2% longer run goal, the economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate. Of course, the economic outlook remains highly uncertain. Making appropriate monetary policy in this environment requires humility, recognizing that the economy evolves in unexpected ways. We'll need to be nimble so that we can respond to the full range of plausible outcomes. With this in mind, we will remain attentive to risks, including the risk that high inflation is more persistent than expected, and are prepared to respond as appropriate to achieve our goals. To provide greater clarity about our approach for reducing the size of the Federal Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy, and that reducing our balance sheet will occur after the process of raising interest rates has begun.
Oh, wow.
Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments, so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework. And in the longer run, we envision holding primarily Treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. In that regard, we will be prepared to adjust any of the details of our approach to balance sheet management in light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet. And we will discuss these matters in upcoming meetings and provide additional information at the appropriate time. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
This is it. This is the big moment. 50 point. Let's hear it. First, I want the first question to be, what about a double rate hike?
Thanks, Michelle, and thank you, Chair Powell. So it's expected that the Fed will hike rates perhaps every other meeting, but certainly in the past, the Fed has hiked at every meeting. So I just wanted to ask, are rate hikes at consecutive meetings on the table this year? Is every meeting a live meeting? And on that note, would the Fed consider front-loading some of its rate hikes, even if it doesn't raise every meeting? Thank you.
Thanks. So as I referred to in my opening statement, it is not possible to predict with much confidence exactly what path for our policy rate is going to prove appropriate. And so at this time, we haven't made any decisions about the path of policy. And I stress again that we'll be humble and nimble. We're going to have to navigate cross currents and actually two-sided risks now.
Don't blow it off.
So, and I'll say also that we're going to be guided by the data. In fact, what I'll say is that we're going to be led by the incoming data and the evolving outlook. We'll try to communicate as clearly as possible, moving steadily and transparently. So, more to your question.
Come on.
We know that the economy is in a very different place than it was when we began raising rates in 2015. Specifically, the economy is now much stronger. The labor market is far stronger. Inflation is running well above our 2% target, much higher than it was at that time. And these differences are likely to have important implications for the appropriate pace of policy adjustments. Beyond that, we haven't made any decisions.
Okay, so differences from the past kind of blew that off, though.
Thank you. Let's go to Victoria Guida at Politico.
I hope he gets asked again. He will.
Hi, Chair Powell. I wanted to ask, you were talking about the health of the labor market, and I'm curious whether you would characterize where we're at right now as maximum employment, and also along those same lines, obviously rate hikes on the table this year. Do you think that the Fed can raise rates, bring inflation under control without hurting jobs and wages?
Yeah, I don't think he's going to answer the max employment Only some have come out and said that.
Sorry, just getting both parts of your question written down. So I would say, and this view is widely held on the committee, that both sides of the mandate are calling for us to move steadily away from the very highly accommodative policies we put in place during the challenging economic conditions that the economy faced earlier in the pandemic. And I would say that most FOMC participants agree that labor market conditions are consistent with maximum employment in the sense of the highest level of employment that is consistent with price stability. And that is my personal view. And again, very broad support on the committee for the judgment that it will soon be appropriate to raise the target range for the federal funds rate.
Yeah.
The other thing is maximum employment will evolve over time and through the course of the business cycle. In the particular situation we're in now, it may well increase. The level of maximum of employment that's consistent with stable prices may increase, and we hope that it will as more people come back into the labor market, as participation gradually rises. And the policy path that we're broadly contemplating would be supportive of that outcome as well. So the thing about the labor market right now is that there are many millions of more job openings than there are unemployed people. So you ask whether we can raise rates and move to less accommodative and even tight financial conditions without hurting the labor market. I think there's quite a bit of room to raise interest rates without threatening the labor market. This is, by so many measures, a historically tight labor market. Record levels of job openings, of quits. Wages are moving up at the highest pace they have in decades. If you look at surveys of workers, they find jobs plentiful. Look at surveys of companies, they find workers scarce. And all of those readings are at levels really that we haven't seen in a long time, and in some cases ever. So this is a very, very strong labor market. And my strong sense is that we can move rates up without having to severely undermine it. I also would point out that there are other forces at work this year which should also help bring down inflation. We hope, including improvement on the supply side, which will ultimately come. The timing and pace of that are uncertain. And also fiscal policy is going to be less supportive of growth this year, not of the level of economic activity, but the fiscal impulse to growth will be significantly lower. So there are multiple forces which should be working over the course of the year for inflation to come down. We do realize that the timing and pace of that are highly uncertain, and that inflation has persisted longer than we thought. And of course, we're prepared to use our tools to assure that higher inflation does not become entrenched.
I don't think the market likes that he said we can raise rates a lot, essentially, without, or there's quite a bit of room to raise rates without threatening the labor market, was the quote.
I have a couple of questions on the balance sheet. The statement on the balance sheet today calls for significantly reducing your holdings. What does that mean? And then apart from moving sooner and faster to shrink the holdings, are there any other ways in which you and your colleagues are seriously thinking about recalibrating this process? And finally, how much disagreement is there around how you should use this tool, including active sales rather than passive sales, or changes in the composition of reinvestments? Thank you.
So I'm afraid to tell you that those are all great questions, and they're questions that the committee is just turning to now. So we had a discussion, as you know, at the last meeting, an introductory discussion of the balance sheet and a teeing up of the issues. At this meeting, we've gone through and carefully put together a set of principles at a high level, and those are meant to guide the actual decisions we'll make about the pace and about all of the questions that you're asking. And I expect that this process will be something that we spend time on in coming meetings. I can't tell you how many, I can't tell you how long it will take, and then, at the appropriate time, we'll provide additional information. So the last cycle when we went through balance sheet issues, we did find that over the course of 2 or 3 meetings, for example, we did come to interesting and better answers, we thought. So we're just in that process now, and at the next meeting, we'll be turning to more of the details that you're asking about. I would say this: the balance sheet is much bigger. It has a shorter duration than the last time. and the economy is much stronger and inflation is much higher. So, and I think that leads you to, and I've said this, being willing to move sooner than we did in the last time.
No dovishness yet, kind of kicking the can down the road. That's why the SPY's falling.
It's really not appropriate for me to speculate exactly what that would be. But I would point you to principle number one, which is the committee views changes in the target rate for the federal funds rate as its primary means of adjusting the stance of monetary policy. So we do want the federal funds rate. We want to operationalize that, and we want the balance sheet to be declining in a predictable manner, and we want it to be declining primarily by adjusting reinvestments.
So if I could follow on that, raising rates and reducing the balance sheet both restrain the economy, both tighten monetary policy. How should we think about the relationship between the two? For example, how much passive runoff is equal to every quarter percentage point increase in your benchmark rate?
Ooh.
So again, we think of the balance sheet as moving in a predictable manner, sort of in the background, and that the active tool meeting to meeting is not both of them, it's the federal funds rate. There are rules of thumbs. I'm reluctant to land on one of them that equate this, and there's also an element of uncertainty around the balance sheet. I think we have a much better sense, frankly, of how rate increases affect financial conditions and hence economic conditions. Balance sheet is still a relatively new thing for the markets and for us, so we're less certain about that. So again, I think the pattern we'll follow is to arrive at a timing and a pace and composition and all those things, and then announce that with advance notice, and it will start in the background, and then we'll look to have that just running in the background and have the interest rates again be the active tool of monetary policy. That's at least the plan. I can't tell you much more about any of the very good issues about size, pace, composition, those sorts of things. We'll be turning to all of those at coming meetings.
SPY's about to turn negative. We're still waiting for a blunt question on could they go for that half-point increase?
Thank you, Chair Powell. It's Neil Irwin from Axios. Glad to be back. Sir, I was wondering if the volatility we've seen in financial markets in the last few weeks strikes you as anything alarming or that might affect the trajectory of policy.
No.
Conversely, to the degree that financial conditions have tightened some, might that be desirable in some ways in achieving your tightening goals?
So, as you know, the ultimate focus that we have is on the real economy, maximum employment and price stability, and financial conditions matter to the extent that they have implications for achieving the dual mandate. And you also know that we look at broader financial conditions, not one or two things, one or two markets. And what we're always asking ourselves is, are we seeing changes that are both persistent and material enough that of a change in financial conditions that they are inconsistent with the achievement of our goals? So that's how we're looking at that. And I don't want to comment on today's financial conditions broadly, but we're not looking at any one market or so. So that's how we're thinking. In terms of what we've seen, I would say this. We said at our last meeting, we published a summary of economic projections, the median participant expected 3 rate increases this year. And, it's 6 weeks, 7 weeks later now. And you have seen that our communication channel with the markets is working. Markets are now pricing in number of rate increases. Yep. Surveys show that market participants are expecting a balance sheet runoff to begin, at the appropriate time, sometime later this year, perhaps. We haven't made that decision yet. So we feel like the communications we have with market participants and with the general public are working, and that financial conditions are reflecting in advance the decisions that we make. And monetary policy works significantly through expectations. So that in and of itself is appropriate.
Okay.
Thank
Still
you.
no
Let's go to
green here on
Howard
the market.
Schneider.
For a year hi, thanks, Chair Powell. Howard Schneider with Reuters. So for a year now, the statements reference the benchmarks for this initial interest rate increase. Now that we're approaching that moment, what are the benchmarks going to be for subsequent rate increases? I know you can't stipulate the path, but how should we think about the criteria for the next step and the next step?
And how much? Somebody asked the question.
Oh, you're right. We haven't gotten to that point yet. We haven't made a decision yet, and we'll make that decision at the March meeting. We'll make a decision whether to raise the federal funds rate. I would say that the committee is of a mind to raise the federal funds rate at the March meeting, assuming that conditions are appropriate for doing so.
Yep.
We have our eyes on the risks, particularly
How much?
Around the world, but we do expect some softening in the economy from Omicron, but we think that should be temporary, and we think that the underlying strength of the economy should show through fairly quickly after that.
Okay.
If I could follow, just on a related question, the December steps had this copacetic sort of set of circumstances where inflation comes down without the federal funds rate ever getting over the estimate of neutral. Given developments since then, do you still think that's a credible narrative for the ultimate path of policy?
My path is highly uncertain, and that we're committed to using our tools to make sure that inflation, high inflation that we're seeing, does not become entrenched. So a number of factors would be, it's not just monetary policy. A number of factors are supporting a decline in inflation. As I mentioned, fiscal policy will providing significantly less of an impulse to growth. We do expect this year, although we do expect now that it will come slower than we had expected and hoped, that there will be relief on the supply side. So that too should lower these supply side barriers, which are a big part of the story why inflation is high. In addition, monetary policy will be becoming significantly less accommodative. So the question is, we'll be asking this question all year long, and that will be, are things turning out as we expect? There's a case that for whatever reason, the economy slows more and inflation slows more than expected. We'll react to that. If instead we see inflation at a higher level or a more persistent level, then we'll react to that. And again, we're well aware that this is a different economy than existed during the last tightening cycle, and our policy is going to reflect those differences.
That means quarter point, folks. That's basically him saying we're going to take this meeting by meeting. That's reiteration right there. They're going quarter point, not half point. I like that answer.
Let's go to Gina.
The market is finally rotating up a little bit. This person's got to get up.
Let's go to Steve Leisman.
Okay, never mind. We got the CNBC guy. Okay. Get it together, people. It's just Zoom.
Mr. Chairman. Mr. Chairman, I have one sort of technical question and one question on principle. The technical question is, if you're going to discuss balance sheet at next upcoming meetings, and you won't begin balance sheet reduction until after you begin rate hikes, it seems to technically mean that you won't or can't begin balance sheet reduction until the summer. Is that correct? That's the first thing. Second of all, you suggested that the with balance sheet running in the background, that you would possibly be raising rates and running off the balance sheet at the same time. That's sort of a technical question, part of it. The principal question I have is, you said it's going to be running in the background, but the statement on balance sheet principle says the committee is prepared to adjust any of the details of its approach based on economic and financial developments, which suggests there's something of a reaction function associated to the balance sheet, and it won't be running in the background. So could you give us any a sense of the discussion or staff presentation on what is the reaction function surrounding the balance sheet? Thanks.
So let me start by talking about that last paragraph. So you'll remember during the last cycle that this process of building up and then shrinking the balance sheet is a complicated one, and it involves inevitably surprises. And so during the prior cycle, we amended our balance sheet principles a number of times. Now, we didn't intend to do that. Events required us to do so. So we got a pretty robust paragraph there that says we're free to do this at any time. And it doesn't mean we're going to, but if the situation turns out to be different than we thought, we're not going to stick with something that isn't working. That's all that's saying. It's meant to be quite a general statement rather than a hint. So, I mean, I like to think that our philosophy of the balance sheet is embodied in these principles. So, the idea that, for example, the federal funds rate is the primary means, of adjusting the stance of policy. It will determine the timing and pace of reducing the size of the balance sheet to foster the dual mandate. That will begin to reduce the size after we begin the process of raising rates, and on like that. I mean, those are all the things that try to describe how we will proceed. But it may be at a higher level to try to get at your question. Asset purchases were enormously important at the beginning of the recovery in terms of restoring market function, as they were right after in the critical phase of the global financial crisis. And then after, they were a macroeconomic tool to support demand. And now the economy no longer needs this highly accommodative policy that we put in place. So it's time to stop asset purchases first, and then at the appropriate time, start to shrink the balance sheet. Now, the balance sheet is substantially larger than it needs to be. We've identified the end state as in amounts needed to implement monetary policy efficiently, effectively in the ample reserve regime. So there's a substantial amount of shrinkage in the balance sheet to be done. That's going to take some time. We want that process to be orderly and predictable. And so those are some of the ways I would think this lays out our the way we're thinking about this. In terms of the timing, I can't really help you. It just says after we get underway. So I would say we're going to have another discussion at the next meeting, and my guess is we'll have at least one other discussion at the meeting after that.
Oh, that's
bullshit. We'll tell you as we make progress, and we'll start the process of allowing runoff and shrinking the balance sheet at what we find to be the appropriate time. I wish I could say more, but honestly, we haven't made those decisions, and we actually haven't even really had the important discussions on a lot of the details that we will have at coming meetings.
Yep. That's interesting. So potentially 2 meetings of discussion.
Thank you. Let's go to Craig Torres.
Before they reduce the balance sheet.
Chair Powell. Good afternoon, Michelle, and Chair Powell, Craig Torres from
Which also
Bloomberg.
implies single rate hikes.
Chair Powell, at the beginning of the conversation, you said risks are two-sided. And I'm wondering if you can elaborate on what are the risks to the elusive soft landing. Is Fed policy a risk over tightening, or what are the risks? And then second, Chair Powell, I have a quick administrative question. Robert Kaplan's disclosure of his securities transactions. In a couple months, Chair Powell, or maybe sooner, you and I will file our tax returns and we'll list transactions and all kinds of things. And next to those transactions, we'll put dates. And Bloomberg asked for the dates of Mr. Kaplan's transactions. The Dallas Fed is not giving us the dates. And I don't see why this is a matter for the Inspector General or anybody else. I mean, why can't he give us the dates? Will you help us get the dates of those transactions? Thanks.
So you asked about the risks first. So the one risk is that inflation risks are still to the upside in the views of most FOMC participants, and certainly in my view as well. There's a risk that the high inflation we're seeing will be prolonged. There's a risk that it will move even higher. So, and we don't think that's the base case, but you ask what the risks are, and we have to be in a position with our monetary policy to address all of the plausible outcomes, and that calls for us to be in position. We have an expectation about the way the economy is going to be evolved, but we've got to be in a position to address different outcomes, including the one where inflation remains higher. And of course, that is a risk to the expansion. We've been saying that what we need here is another long expansion, which is the kind of thing we saw over the last, which is the record long expansion. We saw labor force participation rise. We saw wages persistently higher for people at the lower end, and there really was no obvious imbalance in the economy that threatened that expansion. It could have gone on for years were it not hit by the pandemic. So we'd love to find a way to get back to that. That's going to require price stability, and that's going to require the Fed to tighten interest rate policy and do our part in getting inflation back down to our 2% goal. So I mentioned two-sided risks. A couple things. One, the COVID is not over, and COVID can continue to evolve, and it's just we have to accept that it's not over, and the risks to it can slow down growth, and that's sort of a downside risk from a growth standpoint. I would point to another risk is just further problems in the supply chains, which could slow down activity. And you see the situation in China as a situation there where that's their no COVID policy may cause more lockdowns, is likely to, and that may play into more problems in supply chains. In addition, there's what's going on in Eastern Europe and things like that. So there's plenty of risk out there, and we can't forget that there are risks on both sides. So that's there. That's what I would say. I know you've been all over this issue with my colleagues, Craig, on the issue of information.
SPY is almost negative. Ugh. A lot of kicking the can down the road so far. Oh, it's about to turn negative.
And that is out of my hands. I am playing no role in it. I seek to play no role in it. And I can't help you here.
Okay, now that the SPY broke negative, it is falling even more. That's not good. Small caps rotating down, large caps rotating down, everything rotating down. Next question.
Thanks for taking our questions, Chair Powell, and sorry for my tech issues. I wonder if you could tell us a little bit about where your thinking on inflation stands today. You know, the last time we saw an SEP back in September, we saw that you and your colleagues were projecting that inflation would sort of sink back down quite close to target by the end of the year. And I wonder if you still think that projection from December is a reasonable one, and if your thinking has changed at all, I wonder how you're thinking about that. And I also wonder if you could talk a little bit about the pathway to getting to that deceleration. Like how do we get from here, 7% CPI, to where you expect to be at the end of the year?
So I'd say, since the December meeting, I would say that the inflation situation is about the same, but probably slightly worse. I'd be inclined to raise my own estimate of 2022 core PCE inflation. Let's just go with that.
That's not good.
By a few tenths today. But we're not writing down an SEP at this meeting, but I think it hasn't gotten better. It's probably gotten just a bit worse, and that's been the pattern. So
December was really bearish, so that's not good.
There's a range there, and that range has been moving to the right for a year now. And by the way, if you look at other forecasters, essentially all other macro forecasters who do this for a living, you've seen the same pattern. So what do we think about that? Well, I think we wrote down rate increases in the December meetings, each of us individually. And I think to the extent the situation deteriorates further, our policy will have to address that. I mean, if it deteriorates meaningfully further, either in the time dimension or in the size of the inflation dimension.
Yeah.
So that's how we're thinking about it. As I mentioned, though, I think it's part of this will be that the Fed moving away from a very highly accommodative policy to a substantially less accommodative policy, and then over time to a policy that's not accommodative in time. I don't know when that will be. Those are the things that we're thinking about. That's part of it. Another part of it is that fiscal policy provided an impulse to growth over the last 2 years. That impulse will be less. In fact, will be negative this year. And so that's another thing. The other one is we will eventually get relief on the supply side. And, the ports will be cleared up and there will be semiconductors and things like that. Now, what we're learning is it's just taking much longer. So I think longer than expected. And that, I think, does raise the risk that high inflation will be more persistent. I do think we'll come off of the highs that we saw in the early part of this episode in the spring last year. But really, the question is going to be what is inflation running at, and so we'll be watching that. And our objective is to get inflation back down to 2%. It's also to provide enough support to keep the labor market healthy. The labor market is very, very strong right now. And I think that strength will continue. There's really a shortage of workers. We see it particularly among production and non-supervisory workers and people in the lowest quartile. You see very large wage increases. I mentioned some of the other indicators. So I think that's what we're looking at. And we're also, we realize, I think, as everyone does, that this outlook is quite uncertain and that we're going to have to adapt. And we're going to communicate as clearly as we can, but we're going to have to be adaptable and, move as appropriate.
Yeah, that's not good. That more inflation from December, and December was bearish. Bad news.
Thank you, Michelle. Chair Powell, when you talk about being humble and nimble about the path forward for monetary policy, does that also include the possibility of raising interest rates by larger increments and, say, doing a 50 basis points hike at some point if inflation does not moderate sufficiently? And should we interpret this approach as a departure from the gradual pace that we saw during the last hiking cycle?
Right. So, as I mentioned, we have not made these decisions. We really haven't. And what I can tell you now, though, is that we fully appreciate that this is a different situation. If you look back to where we were in 2015, 16, 17, 18, when we were raising rates, inflation was very close to 2%, even below 2%. Unemployment was not at our estimates of the natural rate, and growth was in the 2 to 3% range. Right now, we have inflation running substantially above 2%, and more persistently than we would like. We have growth even in forecasts, even in the somewhat reduced forecasts for 2022. We still see growth substantially higher than what we estimate to be the potential growth rate. And we see a labor market where, by so many measures, it is historically tight. I think in a way, the least tight aspect of it is looking at the unemployment rate, which is still below our median estimate of maximum employment. If you look at things like quits and job openings, as I mentioned earlier, and wages, you're seeing, and just the ratio of job openings to unemployed, you're seeing a very, very tight labor market. Now, we also know that labor force participation is significantly lower. It's 1.5 percentage points lower than it was in February of 2020. Maybe 1 percentage point of that is retirements. Some part of those retirements are related to COVID rather than just regular retirements. So we think there is a pool of people out there who could come back into the labor force, but it's not happening very quickly, and it may continue to not happen very quickly as long as the pandemic is on. So that's how we think about that. We haven't made, to your specific question, we really have not addressed those questions, and we'll begin to address them as we move into the March meeting and meetings after that.
Let's go to Rachel.
All right.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm wondering if you can talk to us about any metrics that the Fed uses to assess how inflation affects different groups of Americans, especially lower income earners. And are you worried that the Fed underestimates or can't effectively measure the impact of inflation on some of the most vulnerable households? Thank you.
So it's more a matter of, I think the problem that we're talking about here is really that people are on fixed incomes who are living paycheck to paycheck. They're spending most or all of what they're earning on food, gasoline, rent, heating, things like that, basic necessities. Yep. And so inflation right away forces people like that to make very difficult decisions. So that's really the point. I'm not aware of, inflation literally falling more on different socioeconomic groups. That's not the point. The point is some people are just really in prone to suffer more. I mean, for people who are economically well off, inflation isn't good. It's bad. High inflation is bad, but they're going to be able to continue to eat and keep their homes and drive their cars and things like that. It's more, so that's really how I think of it.
Okay.
And, to control inflation for the benefit of all Americans. But part of it is just that it's particularly hard on people with fixed incomes and
SPY is at support. Looks like it's bouncing right now. It's almost down 1% there. 430 support.
Necessities, which are experiencing high inflation now.
Thank you. Let's go to Edward Lawrence.
Thanks, Michelle, and thank you, Mr. Chairman, for taking the question here. So year over year, inflation's at a 40-year high. The input costs for producer price index for all of 2021 was the highest on record. Some investors fear that the Fed might be moving too late. Now, you said no decisions were made on the path of rate hikes, but was a rate hike more than 25 basis points discussed today? And as a follow-up,
there it is. There's the question. There's the question.
As a follow to that, you testified that the supply chain issues could be worked out by the end of the year. You talked about that today. The CEO of Ford, though, told Fox Business today that the chip shortage will last into 2023. So today you said inflation will start to ease this year. I want to drill down and get a timeline.
Look at that S&P bounce off the support line.
Thank you.
So I would not say that I would expect the supply chain issues to be completely worked out by the end of this year. I do not expect them, and I have not expected
0.25.
What I would say, and I have been saying, is that I expect progress to be made in the second half of this year, mainly progress, because we're not making much progress. If you look at a ton of metrics, you can find some that suggest that delivery times are shorter and inventories in some industries moving up. But overall, we're not making progress. And things like the semiconductor issue they're going to be quite a long time. I would think they'll go more than through 2023. In terms of being too late, I would just say this: our policy needs to be positioned to address the full range of plausible outcomes, as I said, and particularly the possibility that inflation will continue to run higher more persistently than we'd expected.
Okay.
And we think we are positioned to make the changes in our policy to do that, and we're committed to doing that. And that's really where we are. In terms of your question about the size of rate increases, we haven't faced those decisions. We haven't made them. It isn't possible to sit down here today and tell you with any confidence what the precise path will be. But as we work our way through this meeting by meeting, we are aware that this is a very different expansion, as I've said a couple times, with higher inflation, higher growth, a much stronger economy. And I think those differences are likely to be reflected in the policy that we implement.
That means it could be 0.5%. That's bad.
Let's go to Mike.
Bear.
Thank you, Mr. Chairman. I'd like to sort of weave some of the strands of your answers together and ask you, as you start to reverse policy, what your goal is. Are you going to be raising interest rates until you get inflation to 2%? Do you want to go below 2% so that on average you get a 2% inflation rate? And because you said we have to protect the employment part of your mandate, is there some sort of circuit breaker that would stop you from raising interest rates on the employment side?
So no, there's nothing in our framework about having inflation run below 2%. So that we would do that, try to achieve that outcome. So the answer to that is no. What we're trying to do is keep inflation expectations well anchored at 2%. That's always the ultimate goal, and we do that in the service of having inflation. We get to that goal by having inflation average 2% over time. And if inflation doesn't average 2% over time, then it's not clear why inflation expectations would be anchored at 2%. So that's the way we think about that. What was the last part of your question?
I was asking if you're protecting the employment side of the mandate, whether there's some sort of circuit breaker there.
Nothing like that. I mean, I would say you have a tremendously strong labor market, and you have growth this year at forecast to be well above potential. I mean, people are forecasting growth. If you think potential growth is around 2, most forecasts are significantly above that for 2022, and that's even with policy becoming substantially less accommodative. So the labor market's going to be strong for some time. we ideally what we're trying to achieve is inflation getting back down to 2%, and we're trying to do that in a process that it accomplishes it, that will also leave the labor market in a very strong position. And no one really knows what that will take. Again, I would say that it isn't just monetary policy that's helping inflation get down. It'll be supply side improvements, and it'll be less fiscal impulse, in all likelihood. So, but monetary policy will do our job. It is our job to get inflation down to 2%, and a situation where the two goals can be in tension is a difficult one. But I don't really think they are here, though, because I think a really significant threat to further strengthening in the labor market in the form of higher participation over time is high inflation. And also high inflation is taking away the benefits of some of these large wage increases that we're seeing now. So we do hope to achieve, and our plan is to achieve both of those goals.
If I could follow up, does the danger of tightening too much as policy works its way into the economy with a lag mean that you should go back to being more forecast dependent in making decisions rather than the state dependency you've been using as a framework for the last year and a half or so?
Dependency was particularly around the thought that if we saw a very strong labor market, we would wait to see actual inflation before we tightened. And so that was a very state dependent thought, because for a long time we'd been tightening on the expectation of high inflation, which never appeared. And that was the case for a number of years. So in this particular situation, we will be clearly monitoring incoming data as well as the evolving outlook.
Next.
Let's go to Michael Derby.
Thank you for taking my question. I want to ask you, with the benefit of hindsight, and I realize, that is what it is, but do you feel that monetary policy and fiscal policy maybe did too much to react to the crisis, and that part of the inflation problem that we're having right now is because the government response, collectively was more than what the economy ended up needing?
So I think it's too soon to write that history, really. But what I would say is this. If you remember what it felt like at the beginning of the pandemic, literally the global economy shutting down in large part, including our own economy, and people going to their homes for weeks on end in masks, and there are no vaccines, and it could be a really long time to get them, and then you have economic activity drops by a shocking amount in one quarter. So there was a real risk of lasting damage. Yep. And I think Congress responded remarkably with the CARES Act, incredibly timely, very powerful. There'll always be flaws in these things, but in real time, it was a remarkable achievement. And we responded, and what we were able to do was, stave off a collapse of the financial system at the beginning and make time for what really needed to happen, which was the income replacement and then the recovery that Congress enabled with the CARES Act. So now that was a lot. And what we did was a lot. And, now, what we have now is we have the strongest recovery of any country. And we have a recovery that looks completely unlike other recoveries that we've had, because we've put so much support behind the recovery. And we're managing the relatively high class problems that come with that, which are high inflation and a labor shortage. So, and these are serious problems, very serious problems that we're working as hard as we can on. Was it too much? Again, I'm going to leave that to the historians. But in 25 years, we'll look back at this incident, which will be a 2, 3, 4, 5 year period, and we'll say, we'll have a much better basis to make a judgment about the actions that people took. But it was all founded, though, in a very strong reaction to a unique historical event. And I guess I'll have to leave it at that. I hope I'll be around to see how that looks in 25 years.
Fair enough. Thank you.
Thank you. Let's go to Gene Young.
Almost still
Thanks,
bouncing
Michelle.
off that support line, though.
Chair Powell,
some investors are expecting the yield curve could flatten or even invert after rate hikes begin. Will that worry you? And how important is that risk in the Fed's consideration for adjusting policy?
So we do monitor the slope of the yield curve, but we don't control the slope of the yield curve. Many factors influence longer term interest rates, but it is something that we watch, and you will know that from when we had this issue a few years ago. And we take it into account along with many other financial conditions as we try to assess the implications of all those conditions for the economic outlook. So that's one thing I would say. Another is currently you've got a slope, if you think about 2s to 10s, two-year Treasury to 10-year Treasury, I think that's around 75 basis points. That's well within the range of a normal yield curve slope. So it's something we're monitoring. We don't think of it as, I don't think of it as some kind of an iron law, but we do look at it and try to understand the implications and what it's telling us. And it's one of many things that we monitor.
And I follow up real quick and ask if it did invert, would you tie it to U.S. fundamentals, or would it be driven by a much broader set of factors?
That's a good question in real time. Obviously, U.S. long-term sovereign debt is an important global asset, and the fact that our rates are so much higher than other risk-free sovereign rates around the world may put something of a ceiling on our rates. I don't know, but it would really depend on the facts and circumstances at that time.
Thank you. Let's go to Brian Chung for the last question.
Last question. Here we go. And we'll do a summary.
Brian Chung, Yahoo Finance. Within the context of just the broad effort to normalize rates, would you describe what you want to do as a gradual hiking? And then secondly, within the context of hiking cycles, it's often the talking point for financial stability and wanting to make sure that asset bubbles don't merge. Is that something that has also factored into the conversation as you start to think about hiking rates? Thanks.
I would describe what we're doing along these lines. This is going to be a year in which we move steadily away from the very highly accommodative monetary policy that we put in place to deal with the economic effects of the pandemic. And that's going to involve a number of things. It's going to involve, and it does involve, finishing asset purchases. It's going to involve lifting off, and it's going to involve additional rate increases as appropriate. And we're going to write down in March our next assessment of what that might be. It's going to continue to evolve as the data evolve. We need to be quite adaptable, I think, in our understanding of this. The last thing we're going to do is we're going to have a couple more meetings, I think, to talk about allowing the balance sheet to begin to run off,
right,
and do so in a predictable manner. And that's something that we will also be doing as appropriate. And I wouldn't, I don't think it's possible to say exactly how this is going to go, and we're going to need to be, as I've mentioned, nimble about this. And the economy is quite different this time. I've said this several times now. The economy is quite different. It's stronger. Inflation is higher. The labor market is much stronger than it was, and growth is above trend even this year, let alone last year. So all of those things are going to go into our thinking as we make monetary policy.
All right. Summary time.
And you asked about financials to have concerns in connection with our policy. Was that your question?
Yeah, within the context of other hiking cycles, it seems like worries about asset bubbles emerging as a result of easy rates has been part of that. I didn't know if that was part of the discussion today.
I would just say this. We of course, have a financial stability framework. And what it shows is a number of positive aspects of financial stability. But you mentioned really asset prices is one of the four. So asset prices are somewhat elevated, and they reflect a high risk appetite and that sort of thing. I don't really think asset prices themselves represent a significant threat to financial stability, and that's because households are in good shape financially than they have been. Businesses are in good shape financially. Defaults on business loans are low and that kind of thing. The banks are highly capitalized with high liquidity and quite resilient and strong. There are some concerns in the non-bank financial sector around money market funds, although the SEC is has made some very positive proposals there. And we also saw some things in the Treasury market during the acute phase of the crisis, which we're looking at ways to address. But overall, the financial stability vulnerabilities are manageable. I would say.
Okay.
Thank you very much.
Thank you.
Well. Unfortunately, hopefully we get a little bit of a bounce here at the end of the day. Now that this is over, unfortunately, the intuition that the Federal Reserve would not come to the rescue. Oh, there we go. Everything froze. There we go. Okay, we're good. We're good. Sorry about that. So here, let's just do this. Unfortunately, the expectation that the Federal Reserve would come to the rescue to save the market is not what happened. This was somewhat expected. That Jerome Powell's job is not bailing out your stocks. This is the most important thing to remember. Jerome Powell's job is not bailing out your stocks. Anyway, okay, let's do a quick recap of this. It freaking sucks. I feel for you. I am also getting burned on some of my longs, but that's okay. That's the nature of it. I'm happy I'm more than half cash because there are going to be some buy the dip opportunities as we now digest this crap that we just heard over the next 2 months. So I do think we're going to have some more buying opportunities over the next 2 months, which was the expectation that was most likely, unfortunately. Anyway. Okay, let's go ahead and do a little bit of Q&A. I am going to watch, though, the SPY just to see if we can get a little bit of a green U-turn, because now once you stop talking, once the conversation stops, sometimes things chillax and go green again. Some of that, like all the people sitting trading and selling and stuff, stop, right? We'll see. We do have Tesla earnings coming up as well, but for right now, let's just do a quick summary of what the Fed just said. And there's a lot the Fed just said. All right. Give me a second here. All right, folks, here's what the Federal Reserve just said. First of all, they kept interest rates at 0. This was the base case scenario that we were expecting, that they would not raise rates in January. They also did not complete the taper as expected. They're still going to be printing and stimulating the economy by the tune of $30 billion next month and in March, which is kind of wild, but they're still going to be printing. So keep that in mind. So this came in at expectations, which was good. The market rallied on this very briefly. Unfortunately, started selling down when we got some news from Jay Powell about what's really going on in the market. And this is what we've got to talk about. All right, this is what Jay Powell says about the market. I want to be transparent. I am 45% long and 55% cash on this particular market. So I'm getting burned by the market going down as well. Unfortunately, that's the way it works with Jay Powell. So, and we're probably going to have more of that. And so that's why I'm keeping that cash, ready for buying the dip. Okay, let's now focus on what Jay Powell said. So first, Jerome Powell, Federal Reserve, conclusion of this January 26th meeting, did say that we are seeing reduced spending in COVID-sensitive areas. However, we're expecting that cases will drop rapidly. They already have dropped rapidly in New York, and we expect that they'll drop rapidly throughout the rest of the United States. This is good. He does say, and this is unfortunately not good news. He says there is quite a bit of room to raise rates without threatening the labor market. This is literally what I've been saying in my videos. That unfortunately, if we have so much flexibility in the labor market, then they can raise rates without affecting the labor market that much. It's kind of like if the labor market's up here and rates are way down here, and inflation's a problem, they could raise rates. And even if they bring the labor market down a little bit, that's okay. It's literally what we expected. And that's exactly what he's saying. Now, he did also mention that, that's in doing so, he gave us some statistics on how strong the labor market is, how the labor market may continue to strengthen, which basically gives them room to raise rates. Inflation. he says, is well above target. And this is where things started getting a little dirty. Well above target. Elevated levels of inflation, especially bottlenecks and supply constraints limiting production in the near term. We knew this. We knew that GE was complaining about persistent inflation. Raytheon doesn't think the supply chain issues are going to end until the end of 2020 or 2022, or at least they're not going to get better until the end of 2022. Jerome Powell reiterated this. Jerome Powell said, the supply chain issues are not going away. They're not going to go away in 2022. In fact, it might take until 2023 for them to actually go away. But that we have some form of disinflation or decline in inflation in the second half. Hopefully. He says that inflation has spread to a broader range of goods and services, and while they expect inflation to decline, it is higher than expected, it is lasting longer than expected, and it's imposing significant hardship on individuals. They do think that an improvement on the supply side should bring inflation down, and less fiscal policy, so Congress spending, will help bring inflation down. However, and this was very bad as well, when he was asked, is inflation better or worse than where we were in the what's it called in the last meeting, in the December meeting, he said it's worse. Things have actually gotten slightly worse, which is bad. That's literally what we did not want to hear. That is not good. Okay, he does say we need a long expansion to continue progressing with this economy. That is slightly bullish. We want a long expansion. That is a good thing. That is helpful of the stock market. But when he was asked, hey, well, what about the stock market essentially and financial conditions changing? Like, does this potentially mean that if the stock markets come down, maybe y'all won't raise rates as much? And what have I always said, folks? I say the same freaking thing all the time. Jerome Powell does not give a crap about your stocks. Jerome Powell is nervous that high stock prices or asset prices could actually create asset bubbles, lead to more risk taking, more debt, and then a crash. So what was his answer when he was asked, hey, prices have come down? You going to say anything about that? He says, look, financial conditions, aka the stock market, matter to the extent they affect inflation and employment. But that's it. And he gave no comments about the market because he doesn't care about your stocks. Remember, folks, we are in literally the opposite of a stimulating time. And I know that sounds weird to say, but look, I drew this little chart here. This is the government and stimulus. Okay, stimulus came in hot and fast on the left, and now it's waning. Soon, very soon, we're going to get a little child tax credit. That's going to come out in March and April, the second half of the child tax credit. We'll get a little bit of a spending bump, and then we're going to go into running off the balance sheet, which running off the balance sheet at the Federal Reserve is another way of removing stimulation from the economy. The downside of this is he didn't really give us clarity in terms of how quickly we're going to reduce the balance sheet at the Federal Reserve. He does expect to end purchases in March, and that interest rates are their primary objective because raising interest rates is a little bit more predictable than trying to figure out how the market's going to respond to balance sheet reductions. So they are a little bit concerned that balance sheet reductions are going to be a little bit complicated. They expect to discuss reducing the balance sheet in March and May. And they may not actually start reducing the balance sheet until the meeting after May, which I think is June or July. It's one of those. But anyway, from J-POW, it looks like maybe no balance sheet reduction yet for 2 meetings, which is good. But it does look like we're pricing in or expecting, Jerome Powell is expecting rates to go up March 16th. And this was my big concern leading into this meeting, that we would get some good news, like a base case scenario, but then unfortunately, we would end up kicking the can down the road for the rest of the issues, leading to more uncertainty in the market. And when you get uncertainty in the market, what happens? Prices go down. Now, that's not necessarily to say that we're going to keep crashing. I think we've seen some substantial potential bottoms Monday and Tuesday, but unfortunately now it's going to shift to earnings, February 10th inflation readings. If February 10th inflation readings come in ugly, things could get dirty again in the stock market. And unfortunately, this is where, even though we had big shorts on small, like a lot of companies, I didn't have big shorts. A lot of institutions had big shorts on small caps because we didn't get the clarity the market was looking for. If anything, we got worse news than expected. News that, crap, the Fed actually thinks that things are worse now than they were in December, not better. And everybody in the market's like, oh, things are better now. Things are better now. Yeah, no, things got worse. So what ended up happening? Market fell. That was pretty rough. Anyway, then we've got, let's see here. He was asked multiple times about the size or pacing of rate hikes. He implied that he said they want to communicate as clearly as possible. But, and this was bad, the economy is in a different place. We have a much stronger economy now than we have had in the past. Unfortunately, when he was asked about, hey, would you consider doing a 0.5% increase? He kind of implied that it was possible that we would do a 0.5% increase because of how strong the economy is right now. So a lot of talk about how strong the economy is, but how bad the supply chain issues are. And so what happens? More frickin' pain. Now, the good news is we did not get rug pulled. So this is where, in my opinion, I begin to start looking at opportunities again and buy the dip between here and March. Now, I think the rest of 2022 is still going to be tenuous. But personally, this is where I go back to, okay, we got through January. We've got pretty much a roadmap here. We could still get rug pulled with a double point increase in March, and we've got that uncertainty that's going to stay priced in the market. Shorts are potentially going to stay priced in the market now. That does mean shorter term bets are going to suffer more. But in my opinion, the best thing to do here is just shares. Something that you own, whether it's small caps, large caps, whatever, is down. Maybe there's an opportunity to buy. Although I will probably stay more cash than invested for some time. We'll see. Maybe we'll get to like 60-40 invested in cash, but I'm definitely keeping a cash buffer and not using margin. Pain would be a lot more right now if you were fully in and in margin, right? But for long-term investors, I always advocate continue to buy the dip. For short-term investors and traders, I think there are trades to be made. Okay, so that is what Jerome Powell told us. Again, talking about moving steadily away from accommodative accommodation for the market. Does expect that the Omicron impacts will be temporary and that we will see that reduction in supply chain issues. But again, the big highlight there is that things are actually worse than they were in December. It has not gotten any better. And Jerome Powell was asked, he stated, in response to a question, if he had to write his economic projections down now, his projections would actually end up being higher for inflation, not lower. So kind of a multiple slaps of bad news there. So kind of no surprise that we saw the market go from these extremely elevated levels this morning, which were a lot of bets that the pain was fully priced in. I made some of those bets too, okay? Not perfect. But anyway, again, still more cash though. Anyway, so we had some enthusiasm here. There were some dips to buy this morning. We ran up to the meeting. We ran as soon as we got good news up here. Ran to about 444 on the SPY. But then as soon as we listened to the meeting, and this is where I said, this is where potential more pain could come from. What happened? We sold down back to SPY support. We briefly broke SPY support under 430. Look at that perfect bounce off the red line here. Recorded this live. Can't move that line. I've had a support level drawn at 430 for a very, very long time. We had a perfect bounce off of that. It does look like it is possible we might get a little bit green going into the close. But with the news that we just got from Jay Powell, it is entirely possible that this is just going to give an opportunity for short sellers to, again, establish some shorts, establish some puts, and rotate potentially out of the market and sit more heavily in cash. Anyway, we are going to be experiencing and dealing with this crap for a while. And there you go. That's what the Federal Reserve just said. So thanks for watching that. Okay, now what we're going to do is we're going to prepare for Tesla earnings. So if you're interested in earnings, hold on, let's see here. I want to see exactly what time it comes out. So if you're interested in earnings and hanging out to see what happens with earnings, I will be transitioning to that. Earnings come out in 30 minutes, but we do have 20 minutes of the market left to deal with here. So what I'm going to do for about a couple minutes here is I just want to listen to what CNBC says about some of what we heard here. And then I can add some commentary and color. And then again, we're going to transition over into the Tesla earnings. And then the earnings call is later thereafter. So we'll see what happens with Tesla earnings. We'll have the expectations written down and everything. And yeah. All right, let's see what they're talking about here. Let's listen in. Oh, I'm frozen again. There we go.
Technology and financials just going positive as far as sectors. Everybody else is lower. Materials, the worst performer. Let's check in on some individual market movers right now. Shares of DraftKings are having a strong day on the heels of an upgrade at Morgan Stanley to overweight from inline. The firm saying the U.S. sports betting market is likely to be very large with only a handful of winners, and it does see DraftKings as being one of those leaders. That stock up 5.4%. Consumer giant Kimberly-Clark dropping today. The company did beat on the top and bottom line, but issued weaker guidance, especially revenue guidance, saying it expects inflation and supply chain issues to persist this year. That certainly hurts when you're making.
If Elon Musk says that too, Tesla could tank.
4%. And finally, a big win for Mattel, the toy company announcing a multi-year global licensing agreement for the Disney Princess Frozen franchises, all sorts of Disney princesses. Mattel winning that license back from rival Hasbro, which has been making the Princess and Frozen dolls since 2016. That stock is up 4% because lots of kids like Disney princesses, Wilfred.
Hasbro down 5% in light of it as well. Straight ahead, Intel and Tesla gearing up to report their earnings at the top of the hour. We'll look at what to watch next in the market zone. And later, Allianz Chief Economic Advisor Mohamed El-Erian will join us to give us his take on the Fed and the market reaction. We'll be right back.
Woo! Okay, SPY is trying to go positive again. That is good. It is trying to push positive again. This is some incredible volatility that you've got going on here. And let's see here. All right, let's see here. All right, so let's see how things are going into the close. First thing we're going to do is we'll look at the SPY. We'll look at BTC. Take a look. I mean, the SPY movement is really, really incredible here, folks. Instantly, if you do not have a line drawn at 430 on the SPY to track this, you should absolutely draw this. Keep in mind, anything that I teach, whether it's technical analysis, fundamental analysis, all of it's in the Stocks and Psychology of Money course. You get buy-sell alerts as well, but just look at those as sort of an idea as to where my head is. Can't guarantee that I'm going to make you money. I took in trade profits, like actual like buy-sell trades, about $3 to $4 million of profits last year. This year is not, I mean, it's slightly green, but this year could not be that good. So no guarantees, right? What do the financial people always say? Past performance and no guarantees of future results. This year is going to be crap. Not necessarily in trades, but just in general. I think this market's going to be poopy, because you're dealing with basically the Fed. The Fed said it themselves. They're basically kicking down the can of inflation down the road that they continuously expect to just kick and punt the can of inflation down the road. Jerome Powell himself said that. So it sucks. But with the exception of options, shares that I'm buying right now, I am going to be long on shares, and I'm going to try to probably by the end of the year be 100% all in on the market again. But I'm in no rush to get 100% invested again right now. No rush. So let's take a look here. We got Tesla. Tesla actually rallying tiny little bit into the close here. Let's see here. Okay. Then I'm going to change the title here to a little bit. I quickly just update this, and then I do want to prep us for Tesla earnings. So what we're going to do is we're going to go through the estimates. Microsoft was up quite a bit more at the open here, and did fall down about 2% from where it was throughout most of the day. Okay. Tesla earnings and oh. Okay, perfect. All right. Oh, I think I froze again. I hate it when it does that. Sorry. I blame Apple. I blame Apple. All right. Well, and Powell for being poopy about the market. But then again, mostly expected. Mostly expected. Mr. Powell, you did it again. All right. So what other earnings do we have here? So we've got Tesla, Intel, Levi Strauss, ServiceNow, Whirlpool. We got quite a few earnings today. Let's listen to CNBC just for another minute or so here. Then I'm going to get into the Tesla estimates.
We will talk crypto and more with Galaxy Digital's Mike Novogratz. Crypto, by the way, hanging in there, Bitcoin higher. But first, we've got just about 15 minutes to go here in the trading day, and we are now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. And today we've got Ritholtz Wealth Management CEO Josh Brown back as well. Welcome, Josh. We will kick it off with the broader market. Stocks volatile again, another day of wild swings after the Federal Reserve Chair Jay Powell's press conference. The Dow currently is down about 40 points or so. It hit its highs of the day right after the Fed's statement came out at 2 o'clock, then went down to its lows of the day as Fed Chair Powell was speaking. Josh, any big takeaways for the Fed as it relates to your next move and what you're telling your clients to do?
Let's hear it.
So I listened to like 20 minutes of it, and I think the most important point that he made was that he is aware of his effect on market expectations, which of course he is. But that's important because one of the things I've been saying, I think this is the third week now, is that the Fed is going to use its mouth well in advance of it actually using its tools. It always does. And in this instance, it's no different. And the market is moving, both bonds and stocks, toward where the Fed ultimately needs them to go if we're going to get inflation moderating. I say on its own, it's not really on its own, but
he's optimistic.
You have to believe that a $38 trillion stock market is now extremely important to the wealth effect that drives a lot of what's going on with inflation. Not all because of supply stuff, but on the demand side, stocks and home prices are the two big things. Home prices are now moderating, fourth month in a row that market is cooling off. And now the stock market started the year with the worst January pretty much ever. So these two things get the Fed.
That's literally not what Powell said, but I'll clarify in a moment.
Even having moved the chess piece yet. So I think it's constructive. I liked hearing Powell point out that he is aware of that impact. And I think markets are being rational in light of the fact that we've probably been stimulating for 6 months longer than we should have been.
Yeah. Mike, I'm interested in your take on
Look,
what
the Jerome Powell did not say that, like, because he's aware of the market, the wealth effect is going to help him not raise rates or whatever. It's not what he said. He said he pays attention to the market to the extent that the market actually affects full employment and inflation. But because we have so freaking much employment, so many job openings, and we don't have enough people, we don't really have to worry about employment right now. The big thing we have to worry about is inflation. Josh, it's literally not what the Fed said. And maybe if you had listened to more than 20 freaking minutes of it, you would have gotten that. Dang.
It was 100% within the range of the last 5 trading days. So once you kind of break through and widen out the scales of what these...
Hopefully you could hear me well. Let me just ping really quick here. 1 sec. You're joshing me. I'll be right back. It's going to go black for a second. I'll be right. Okay. Hopefully that's better. See, I mean, look, I hate to say it. Like, I am a perma bull on the inside. I bought this morning. I wish I bought this afternoon. But, the market in the short term is one of those things where it's just like, woulda, coulda, shoulda. But I do want to, again, be very clear. I want to buy to the point where I'm fully invested at some point this year. But today just reiterates, there's no damn rush, folks. There's no rush. And I think that is an incredibly important lesson here, and it is be patient. Be patient with the market. It sucks, but that's just a market that we're in right now. So keep that in mind. Okay, let's listen to another minute here. CNBC. I'm pulling up the Tesla expectations.
Nasdaq's now about 16% or so off its highs. You've been looking at the history of drawdowns. What are you concluding about what we're going into here?
Well, I'm glad you're giving me an opportunity to talk about this, because this is what we are actually talking about with clients right now. And for the most part, it's us reaching out. It's not clients reaching out to us. I don't think it's been quite as volatile as it would take for people to really get nervous. But I think it's important to point out this year is not the aberration. Last year was. Last year, the S&P did 30%, and the max drawdown was 5.7%. That's bizarre. A lot of that is because of how active the Fed has been in these markets stimulating. What's going on now is entirely within the range of historical probabilities. The average drawdown over the last 94 years is 16.5% intra-year, which means half of them were worse. And if you look at those, typical drawdowns, in 59 of those cases, you're down in excess of 10%. In 24 of them, you're down more than 20%. So this could get worse and still be normal. And I don't think people have a grasp on this concept either, which is that just because you have a 16% drawdown, an average or worse drawdown.
So okay, let's talk BTC here. I'm sorry, not BTC. Let's talk Tesla here. Tesla earnings expectations. So I'm going to write these down with you. I highly recommend, if you are preparing to, listen to Tesla earnings and potentially buy Tesla in the after hours if it falls or whatever, you got to write down these numbers, because that's going to, I think, give you the best advantage compared to the suits and their computers. All right. So, all right, we know deliveries were great, right? A lot is going to come down, I think, to the conference call. So keep this in mind as well. Tesla's got to show very strong battery potential and a strong product roadmap. So I'm going to write down what our needs are. We need strong battery production roadmap. Maybe they can tell us a little bit about the new battery cells they're working on. Is it the 4650s, right? 4650 battery. Is it the Tesla? What is it? 4680. I knew I was slightly off on that. 4680 cell. That's what we want to hear updates on. We also need updates on the Cybertruck. We keep getting teased by it, but that just pumps the stock and doesn't give us reality. So strong battery production roadmap. Need more information on the 4680s. When are we actually going to get these structural batteries? Because that's going to help margins go up. Then we got to look at Cybertruck. What is the roadmap for a Cybertruck? What about a $25,000 car? Can we potentially see that? So battery production, Cybertruck, $25,000 car, margins, and supply chains. Those are going to be big issues as well. Okay, those are expectations. Let me now go to numerical expectations. So, oh my gosh. So the average move on Tesla is 2.88%. Folks, the implied move is 10.33% right now, which is wild. All right, give me 1 second. Okay, 1 sec. Okay. Okay. There we go. That's done. So good. Now let me give you the exact numbers here for Tesla. We know we're expecting let's see here. Okay, numbers. So adjusted EPS. We are expecting adjusted EPS. We are expecting 2.365 for dollar sign 2.365 for Tesla. EPS, we're expecting 1.93. That's the GAAP EPS. Then we're expecting revenue of 16.64 billion, and we're expecting net of 2.68 billion. Okay, so then we have, there we go. Now we have revenue. Okay, those are the numbers that we're expecting. Let's go ahead and hop on over to their last sheet. And I want to show you specifically the sections that we want to pay attention to once we get the Tesla release and figures. Tesla. 3 months ago. All right. So this was the last release from Tesla. And the big things that we want to look for from last time, and we're going to compare these over, were, see this right here. See this 30.5 gap automotive gross margin, 28%, 28.8% without the credits. That's huge. I highly recommend you write that down. So we have, I don't know, I'm going to write this down, 30.5% gap automotive gross margin versus the 28.8 without credits. That's the Q3 number. So if we could beat that, that's going to be huge. Oh, also on our needs list, we want to talk a little bit about FSD. What are the plans to get more people able to use full self-driving? And what are expectations for the rollout for this? That's a big deal. So we've got that. We have net operating margin. It's more like your bottom line here. Before taxes, net operating margin was 14.6% in Q3, so we'll want to compare that. They did complain about the semiconductor shortages and congestion last time. Automotive revenues, we have total revenue expectation of 16.64. Of that, auto expectation is last quarter was. Auto expectation last quarter was 12 bill, but I don't know that that's really going to matter too much. Free cash flow could be interesting. So free cash flow last quarter was a 1.328 million free cash flow. We had an average selling price last quarter of 49,792.5 in Q3. That should go up with the Plaid sales. Good. Okay. I'm just going through the rest of the report here from last time just to get a quick little reminder, and then we're going to go. We've got 2 minutes to go before the bell, by the way, so not much. All right, let me listen to Sarah here for a second, and we're going to look at the sticks for a minute.
A pretty pronounced turn for the negative side in terms of the volume split in the New York Stock Exchange. It was pretty much 3-to-1 positive before. Now it's closer to 2-to-1 to the negative side. So a pretty big swing. And it is the cyclical sectors getting hit on this perceived hawkishness out of Jay Powell. That's the traditional playbook, by the way. Cyclicals are the ones that are going to get hurt early in a tightening cycle. Take a look at gold. We had some chart folks gotten pretty excited about gold in the last few weeks. It's kind of nice little short-term uptrend. People thought maybe it could break out. Here again, no, it's not happening right now. Real rates are a lot less negative right now. So we'll see how the chart fares from here. But it kind of got swatted down from this bid to potentially break out above like 1875. The volatility index has been kind of all over the place. It was down 3 points from yesterday's close at one point, and now we're kind of in the 30 range. So we're still up there, kind of agitated, but nothing too crazy on a day-to-day basis. We'll see if that can bleed lower as we clear the Fed, Wolf.
Just 40 seconds left, and we're basically flat now on the S&P 500, having been higher by 96 points, lower by 52 points, down by about 100 points or so on the Dow, a third of 1%. The Nasdaq is essentially flat. So as you can see there from that intraday chart, well off the highs, slightly off the lows, flat ultimately, and lower week to date. I think is a key point to make because it felt like we bounced so often this week.
Is Discord down?
For the week as well. Financials and tech, the two sectors that end in the green, real estate, materials, and communication services at the bottom of the pile. Yields moving quite significantly higher post the Fed meeting as well.
All right. So there we have it. Let's see here. Okay, yeah, that's weird. No, okay, some people are saying it's working. All right. Yeah, I don't know. I just keep getting like this pinwheel of connecting. I saw some people saying it's in and out. Oh, okay. All right. Well, anyway, I mean, just a very, very nasty market, folks. It is very difficult to make money in this market right now, unless you're just like pure short. And boy, oh boy, it has been nasty. But it will continue to create some buy the dip opportunities for us. Dow Jones now down 0.38%, S&P down 0.15%, NASDAQ closed 0.02, so basically flat. Russell down 1.23. So those shorts paying off again for the institutions, unfortunately. But that's the way the cookie crumbles. So let's take a peek at how things ended up today. It was a wild, absolutely wild day. Let's peek here. So we got Luminar still ended up about 8.96% today. I still think there's an opportunity to build big positions in small caps, and now that they've come down even more, I'm probably going to add over the next couple months to the small cap positions. Though I will say, brutal day here. With some of the swings that we've seen intraday, especially after Powell, like DraftKings was up way more. AMC was rallying at one point, and it looked like it was going to keep going. The trends were there. Everything was there. Powell just came in and ruined everything. So if you made a trade today and you lost, blame Powell. You've got even a Tesla was up almost 7% at one point. Affirm was up over 60 at one point, and it just got ripped away right away. Tesla in about 8 minutes, folks. Let's go ahead and listen to. Let's see which earnings they're reporting here. Is it Intel?
18.3. The EPS 109 per share.
Yep.
The forecast was for 91 cents. The guide, though, for the quarter ahead, a little disappointing. On the top line, fine, 18 billion. 18.3 billion. A forecast was for 17.6. The EPS, though, a little soft. The non-GAAP EPS guide, 80 cents per share. The expectation was for 86 per share. I need to find the.
I told you, folks, the guide. It's gonna be in the guide for Q1. The guide that we're just gonna be in this continued pain mode, and the guide is going to be everything. It is absolutely wild. So the guide for all of these earnings is going to be pretty clear. Clearly the impact that could be the thing for Tesla as well. In fact, I mean, we wrote down our needs list for Tesla: strong battery production, Cybertruck, 25K car, FSD, margin, supply chains, right? That's what we're looking for. And that all has to do with guidance. Intel down about 2.69%. You've got, let's see here. Let me look at LLP. Okay, so Intel is 18.3 billion in Q1 revenue. Estimate was 17.67 billion. That is a beat on the Q4, but again, the Q1 came in at an 80-cent adjusted expectation. That's almost 10% lower than expectations of 86 cents. Ouch. Ouch, 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 ouch. Somebody here says, as soon as I saw some of my losers skyrocketing, I sold and stashed cash. Good job. I think a lot of people in this market are going to do that. I do not fault you at all. That I don't fault you about at all. All right, give me 1 second here. All right, Tesla on deck in about 5 minutes. Nope. Tesla, hold on a sec. I think Tesla is popping through right now. Okay, Tesla comes through with a beat on adjusted EPS. Tesla comes through with 2.54 on adjusted EPS. EVs can be more profitable than combustion engines. We've got free cash flow comes in at 2.78 billion. Oh my gosh. Oh, automotive gross margin comes in at 30.6. That's like a fraction higher than what it was last quarter. But that's a beat. This is good. Tesla killing it. Tesla's up about 1.8% in the after hours right now. Let's go ahead and take a look. Look at that. Tesla moving here a little bit right now. That's really, really exciting. These numbers are amazing for Tesla here. Hold on a second here. So FSD software is still a primary focus of action. Aims to increase production as quickly as it can. Where's the guide? Where's the guide? Sees 50% average growth rate in vehicle deliveries. This is incredible. Come on, give us the outlook. Where's the outlook? Software-related profit should accelerate profitability. Good. Q4 revenue came in at 17.72 billion versus the 16.64 expected. We need guidance here. Come on. Tesla shares dropped 3.3% right now. Oh, now down. It's vacillating around 3%. This is it. Look, what do we freaking say about this market? It sucks, man. It's literally good news is bad news over and freaking over again. Oh my gosh. Tesla saw a continuation of global supply chain challenges. Tesla making progress on the industrialization of the Cybertruck. That's not good guidance. Factories have been below capacity for several quarters. That's good long, not great now. God, man. It's just supply chain, the main limiting factor. I shouldn't have bought anything this morning. That was stupid. But you just don't know. We all of the expectations for my market have been coming true. Let's see here. Okay. I want to get the press. Here we go. Shareholder deck. Tesla software. Okay, we saw that. In process of building dedicated Megapack factory. Oh, that's good news. Expectations. Good. Wow. Tesla's down now about 4%. It's not as bad. It did go down as much as 5% there for a moment. I'm going to go through the slide deck here in just a moment. But this is, again, literally good news is freaking bad news in this world. And it's just, 2022 sucks. Sucks to suck. All right, investor presentation. Now down about 4.6%. Let's go through the actual pamphlet here together. What do we got? Operating. This free cash flow number was amazing. 2.8 bill. Come on, man. That's so good. Record vehicle deliveries. We knew that. This is so good. Margins going up. Come on, man. This is a good earnings report. Cybertruck planned for Austin production after Model Y. Supply chain issues keep it under production. All right. Man. Jeez, man. Okay. It is so crazy. Okay, here we go. Let's see what else we have. There should no longer be doubt about the viability of profitability in electric vehicles. Yeah, no kidding. With our deliveries up 87%. After a successful 2021, we focused our shifts focused to the future. We aim to increase production as fast as possible, not only through ramping production at new factories like Austin, Berlin, but also by maximizing output at Fremont and Shanghai. want to add capacity. FSD remains one of our primary areas of focus, should accelerate profitability overall. But again, no, I don't think we've gotten guidance here, which is not ideal. I'm still waiting to see if guidance ends up coming through. Tesla's now down almost a full 5%. Oh my gosh. Oh my gosh, it's down 5.7 now. Now we have a support line at 870 right now. So it is or at 879. It is at support right now. That is crazy. Again, the TA taking off here. We are bouncing off the support line. No freaking way. Again, the TA was, come on, folks. How could you got to be freaking kidding me right now. You got to be absolutely kidding me. That's it. I'm a go in here and I'm a buy. I don't know. What should we buy right now? 69 shares? Let's see if I can buy in the after hours. We want to buy at 880 in the limit. 880. They're so good. Extended hours. 60K. 880. Oh, it's at 887. Okay. That's all right. I'll move it up. Hey, stay over here. So you go through. Only one share went through. Get out of town. All of that should go through. Come on, man. No. Stop it. Well, I just want the shares. Just give me the 69 shares, will you? There we go. Jeez, man. But remember, as Chris here says, there's no rush. There is no rush. But look, can you believe the bounce off of that TA right there? Now, come on, man. You haven't thought about checking out my programs and building your wealth link down below yet. Check it out. Use that coupon code. My birthday's in 2 days. All right. Okay. Anyway, going back to the sheet here. Oh gosh. Well, buy the dip, I guess. Creates more of an opportunity here. What are we doing? There we go. Okay, here we go. So back into this. So we are at, what are we at here? We are at, okay, here we go. So automotive revenues, 15.964 billion. Right here. That's awesome. Total revenue 17.9. This is so amazing. Look at that. Oh my gosh. GAAP margin coming in at 27.4. That's incredible. What's our margin with I want to look at here. Automotive gross margin 29 point. Look at that. It keeps going up. How is it that this company is going down when you have margin skyrocketing like this? It is just like ridiculous. Such a good company. It's all right. That's just the market we're in right now. Just extended by the dip periods. Operating expenses, 2.2 bill. Operating margin, 14.7, somewhat similar to last, up slightly. The free cash flow explosion here, folks, this is huge. I mean, we doubled free cash flow here. Absolutely incredible. Really, really good. We've got, let's see, on this side, I do want to see solar as well. That's going to be somewhat critical. Growth in vehicle deliveries, growth in other parts of business. Operating income improved to 2.6 billion in Q4 compared with same period last, resulting in a 14.7% operating margin. We know that. Improved profitability of leasing and service and others. Let me see service. Service, they usually lose money in. We will find out. Where's service? We're going to go through this, but one sec. If I go to their statements, I'm going to be able to see how services and leasing has actually improved. Here we go. So automotive leasing is right here. And the number we're looking for is 628 versus, oh, wow. Yeah, okay. 320, the margin should be up nicely right there. Let me see here. 628 divided by 396 divided by 628 is about a 63% cost. That's expected. Okay, then we've got, but actually I think that is slightly better. And then what about services? They used to lose money hand over fist on services. 1064 in revenue. Wow, slightly profitable. They were slightly profitable last time as well, though. They used to always lose money on services, so you're actually finally starting to see this U-turn a little bit here. Ugh. Okay. Overall, quite frankly, very, very good report here. Deliveries were great. Solar deployed, kind of stagnant there on solar deployed. I'm a little disappointed in that, actually. Look at this storage deployed. You had a decline of 38% year over year on storage deployment. That's not good. Why? That's unfortunate. Let me see what other headlines we're getting here. Supply chain constraints seen throughout 2022. Oh, that's not good. Supply chain issues is main limiting factor. Yeah, anyway, okay. So I don't like that decline. Let me see over here. Builds of Model Y started late 2021 at Gigafactory, Texas. After final certification of the Y, of the Austin-built Ys, will start deliveries to customers. Fremont has, we believe there's a potential to expand overall capacity to beyond 600,000 a year at Fremont. Yeah, there's a rumor for a while that they might be able to get up to a million in Fremont, though. It's going to take a lot of expansion. Shanghai, production of both Model 3 and Y continuing to ramp further. Giga Shanghai continues to be our main export hub. Berlin, they're in vehicle production testing phase. Still building with the 2170 battery cells. So they're not ready yet on the structural batteries. I mean, Battery Day was in like 2020. And, we still haven't seen good moves here. The team continued to iterate on FSD beta software, releasing 7 updates throughout the quarter. Okay. Vehicle software. In Q4, we released a new user interface. Powertrain and manufacturing. 4680 cells. We believe our current projects, including large casting, structural battery pack, 4680, and many others, should help us continue to minimize our product cost. Yes. Doesn't look like we have a particular guide here. Energy storage deployments increased 32% year over year. But why did we have that crash at the end of the year? They didn't give us answers on that. So we'll want some answers during the conference call on that. Sufficient liquidity, sufficient cash, photos and charts. Record production, 2021. Okay. Oh, that looks cool. $5.5 billion profit for the company. Gigafactory, Texas. Gigafactory, Texas. Structural battery pack. Oh, so they're working on it. Yeah. There's the Tesla Semi. Wonder if we'll get any kind of guide on that. Any kind of news. Let me see. EPS. EPS was diluted $2.05. Let's see. Where are they seeing the 5.5 billion in profit? Oh, that's for the entire year 2021. I see. Okay. Balance sheet. They've got at the end of the year, they ended with $17.5 billion of cash and equivalents. Look at that. That free cash flow boost is really giving them, some extra profitability here. Tesla stock is moving to the upside a little bit. It's about 918 right now. We'll see what happens in that conference call. I do expect that Elon Musk could end up talking up these supply chain issues, and that could unfortunately hurt the stock a little bit in the short term. There it is. Okay, that is Tesla. Let me see if there were any other earnings to report on here. Just a headline that Tesla Sync says supply snags keep plant under capacity. Okay. We talked about Intel. And that's really it. Okay. Well, folks, no Model X until 20. Oh, these are okay. You're talking about like when the vehicles might be available. If you go to the ordering page, you can kind of watch that roadmap. So, yeah, expect volatility here. I will say today was a day of the support lines. We saw the bounce that I drew off of 430. That's been there for a while. Good bounce off the SPY. We're really testing that floor. Now we're testing this floor over here on Tesla. We are rotating down again. We do have Tesla's earnings call coming up. Tesla's earnings call, I believe, is at 2 p.m. 2:30 p.m. 2:30 p.m. for the call. So we've got about an hour and 10 minutes for the call. Somebody here shouting out 60K full self-driving users. Nice. Yeah. Okay. Looking at the market here broadly, folks, even though we had, poopy doopy here from the Fed, I still believe there is an opportunity in a nice small cap rotation. Intel and Tesla are leading the way down. You do have Tattooed Chef down about 1.7% here in the afters. HUD 8 down a little bit. So we did get a little bit of a drawdown, unfortunately. Actually, a good chunk of a drawdown after JPOW. So betting on JPOW was a mistake, but that happens. And we'll see what happens. 2022 is going to be something. Buckle up, folks. As we're watching it right now, Tesla is falling down about 3%. Thanks so much for being here, folks, and we'll see you in the next one. Thanks.